Good morning, all the friends, and thank you for attending little off big topic. I was also concerned that because as and when we are carrying out any topic other than topic Companies Act, people are concerned and the attendance comparatively goes down. But though it is a Christmas weekend and New Year weekend, I am surprised the kind of attendance again we are getting. Thanks a lot for this, support. And always, as and when we are going out, people are giving and appreciating this program. Thanks a lot for that. Keep on giving suggestions. It helps us. So let's start today's webinar on an insight into Accounting Standard 18 vis-a-viz Related Party Transaction. We are also taking Accounting Standard 24. Friends, one will wonder why this accounting standard, but we have now, I will not say only CS friend, we have CA and CS friends in this webinar. Mr. Pramod, lot of CA attends our program, and we are, that's always considering taxation and accounting aspect on each topic on whenever we present. And so I'll say that this will give combined knowledge of most important thing in the corporate world today is related party transactions. It has a lot of compliance, disclosures, how you disclose, when you take approval, prior approval of shareholders or board, or that all is covered. Today's our attention will be on accounting standard more, though we have covered certain part of Companies Act to compare it. So it will give you idea. Why we should know accounting standard? I think more will be spoken by Sudhakar and Pramod, but just to give you idea, when a employee CS I will say, CA knows, and practicing CS, when they connect to the businessman for related party transactions, you have to give holistic view. You can't say under Companies Act this and under accounting standard this. We should know this. And that's why one liner I'm telling, but more, attention will be given by Sudhakar and Pramod. So I'll request now, we have with us today, our panelist, Mr. Pramod Jain, who is a CA and CS. And welcome, Mr. Pramod, to today's webinar. Thanks a lot.
Thank you.
To formally, and we have formally introduced Mr. Pramod Jain. Mr. Pramod Jain is a accomplished independent director, finance professional with over 20 years of experience in corporate governance, strategic financial management, business valuation, and insolvency. He has leadership role as a finance head, legal head, company secretary, and guided both Indian and multinational corporations through critical transformation and regulatory landscape. A global business coach, Mr. Jain conducted training workshops in over 50 locations worldwide. Very wide, different, experience, Mr. Pramod has. Thank you for being there. Currently, he practices as a CA, valuation professional in IP, social auditor, advising organization on India's IFRS, strategic corporate action, value creation, and SEBI regulation. With expertise in business valuation, corporate turnaround strategies, sustainable reporting, Mr. Jain is a trusted advisor and advocate for good corporate governance for the organization across industry. Welcome, Mr. Pramod. Thanks a lot for your time.
Thank you.
Today, we have with our presenter, Mr. Akshay Patel. Akshay Patel is a member of ICAI, member of ICSI, law graduate from Mumbai University. He has multifaceted experience in finance, accounts, compliance, and legal fields. He has experience in the field of auditing, taxation, corporate law, governance, and legal principles, specialized in due diligence, public issuance, business structuring, and advisory services. He ensures compliance with SEBI regulation and other corporate laws. With more than 12 years extensive experience in compliance, advisory, and financial domain, he emerges as a guider for regulatory compliance. Thanks a lot, Akshat, for giving this
Thank you.
time. We have with us as our own Mr. Bala and Sudhakar, who don't need introduction now. With this, I will request Mr. Pramod Jain to say a few words on the topic, and then Sudhakar, Bala, and Akshat, then you can start the presentation. Over to Mr. Pramod. Thank you.
Yes, thank you, Deepthi. It's indeed a great pleasure for me to be with all of you. It's really a pleasure to discuss this very interesting topic with the stalwarts like Sudhakar ji, Bala, and yourself. This topic is of vital importance for every one of us for many reasons. Number one, we company secretaries do sign the annual accounts of the company, and it obviously would mean that there is a lot of responsibility which the statute, the government, and the regulators put on our shoulder. There are many areas where we have to ensure there's a good corporate governance. Related party transactions is one of them and a very important one. Let me begin with what is good corporate governance. And if we have to understand good corporate governance, we will need to understand as to what is purpose of a business. In brief, I would say, invariably people think that the purpose of a business is to make profit. And I would say that is not correct. Purpose of a business is not to make profit. And why do I say this? I say this because making profit in business is compulsory. Making profit in a business is mandatory. Making profit in business is not a matter of choice, not a matter of an option. If you are in business, then you better make profit. And if you are in business and you are not making profit, the least that you can do is to hand over that business to somebody else who can make profit out of it. As a matter of fact, today we have a law in this country, as we all know, and that is Insolvency and Bankruptcy Code, which is nothing but in case if an organization is not making profit, that organization is given to somebody else who can make profit out of it. So therefore, purpose of a business is not to make profit. Then what is the purpose of a business? And the purpose of a business is to create value. And create value. And when you say create value, meaning what? When you say create value, it means making this world a better place to live today than what it was yesterday. And that is the meaning of creating value. So all the businesses all over the globe ultimately are nothing but engine of bringing socio-economic transformation in the society. And that they can do by creating value. And so create value for what? Create value to strengthen economy of the country so as to make a positive difference in everyone's life without causing irreparable damage to the planet. Now, this is what I can say is the simplest definition of good corporate governance, which also includes what is sustainability. So when we say without causing irreparable damage to the planet, that means that is what sustainability is all about. Now, why there is a need to regulate related party transactions? Now, for us to go deeper into it, and I just thought before we start delving into it, let us go to the soul of the topic of related parties and related party transaction. कि why क्यों जरूरत पड़ी है कि भाई related party को regulate किया जाए? And the reason behind is the evolution of business. So the business have evolved over time immemorial from a small, proprietary concern to today globally listed large business corporations. When the businesses were small, when they were managed by individuals, so the individual was the owner and individual was also the manager. And therefore, the stakes, whatever they were limited to the individual who was owning that business. And therefore, in case if he did anything wrong in that business, he was the perpetrator and he was also the sufferer, and therefore it was okay. Today, the scenario has undergone a huge change. And what is the change? The change is separation of ownership and the management. So the owner of the business is somebody else, and the manager of business is somebody else. And therefore, there is a full possibility, there's a possibility that the people who are at the helms of affair of a business may misuse their power or their authority to pass on the unfair business advantage or unfair benefits to themselves or to their related relatives or related parties. As, and therefore, if a business is indulging into such kind of siphoning of unfair advantage or unfair profit to their relations or their relatives, that means it is being done at the cost of the other shareholders, and therefore there is a need for regulating the related party transaction so that it does not happen for the disadvantage of the remaining shareholders. Now, what is the intent of related party regulations in general? Is the intention of the government or the regulator to comprehensively define related parties and the related party transactions? Or the intent of behind the RPT regulation is to ensure that the businesses do not pass undue favor to any party, or the promoters or the people at the management indulge into certain transactions for self-enrichment or benefiting their related parties. And that is what we all have to remember as uh, as the people responsible for implementation of good corporate governance in the organizations, that the intent is not to define the related party. As a matter of fact, if one has to really look at the good corporate governance, then one will have to go beyond the definition given, whether in the Companies Act or in the LODR or in the accounting standards. We'll have to go beyond the definition given in these statutes of the related parties so as to implement the good corporate governance.
Thank you, Mr. Pramod, for your good words. And with this, as presentation goes on for accounting standard, I'll request to add your experience and your inputs on the topic. And I'll request Sudhakar to say a few words and Mr. Bala, and quickly we can start because we are crossing 11:15. Thanks. Thanks.
Very
So,
much, Deepti. Yeah, sorry. Yes, Pramod.
no, please go ahead, Sudhakar.
Yeah, good morning, everyone. And in fact, today's topic is very, very important. And when we were contemplating to hold this particular topic, we were wondering that, as Deepti has rightly said, whether we will have sufficient audience, because this is a topic other than listing regulations, other than Companies Act, other than insider trading regulations, and so on and so forth. But when you see the 277 people who are attending this webinar, the two at the fag end of the year, and most of the people are on vacation. Had that been not there, you see the audience this thing. So this related party transactions, this is the one of the ultimately for the last 1 decade, though we are implementing it, it is having its own nuances. Most of the times, whenever I used to address, I used to say that related party transactions is a Nayan Haveli Dulhan, and this bride has its own tantrums also, its own nuances also. So similarly, that most of the time as company secretaries and chartered accountants, we give importance. Of course, chartered accountants might not be fall in this category, but most of the company secretaries, we give importance to the compliances, but not to the disclosures. Because we always leave the disclosures part to the CFOs or the accounts people. But the company secretaries have to realize that it is equally their responsibility also to ensure not only the compliances, but also the disclosures part. At the same point of time, this AS 18 and Ind AS 24, if a related party, when the definition is given in the accounting standards, the definition is given in the Companies Act as well as in the listing regulations. In the listing regulations, they have covered the related parties under the Companies Act as well as accounting standards also. So the companies which are not listed, they are confined to the related party definition under the Companies Act only. Several times the question comes that people think when we say that unlisted companies and private limited companies, they have to confine to the Companies Act. Sometimes what happens is they also say that means we are not concerned with the accounting standards. Answer is not so. At the same point of time, we have to also realize merely it is a related party under the accounting standards doesn't require the unlisted companies and private limited companies to ensure the compliances under the Companies Act. That differentiation, the demarcation is to be very clearly understood. If a related party falls under the definition of Section 2, subsection 77, then only the compliances under Section 177 and 188 or 189 are required, unless until your company is a listed company. Otherwise, it is not required. However, for the purpose of disclosures in the financial statements, you are concerned with accounting standards. So this relationship one has to understand very clearly. As far as the disclosures in the accounting standards are concerned, there are two types of disclosures. One is the who are all your related parties, whether any transaction is there or not there, you have to give the name of the related party in the financial statements. At the same point of time, apart from this, also the related party transactions which have taken place during the financial year, though the transactions are also to be reflected in the financial statements. This is the primary thing which, as company secretaries, we have to understand. And similarly, as company secretaries and key managerial persons, or the secretarial auditors, as if you are in the practice, it is our responsibility to ensure the compliances under the Companies Act. So we have to also have a good command as far as the accounting standards are concerned. In fact, yesterday only I was discussing with Pramodji because we both are chartered accountants. Still, that I will always the company secretaries having some kind of an averse as far as the accounting standards are concerned. One of the reasons for that is if you read the accounting standards, the language is very ticklish and very complex also. So if you see the accounting standards and vis-a-vis the secretarial standards, the language in the secretarial standard is very simple and very easy to understand, which is not so in accounting standards. So in fact, in the future webinars, we have also decided that the accounting standards which are relevant to the company secretaries, we will take up in our future webinars. And Pramodji is having an authority on this particular subject. As and when we will be organizing the webinars on accounting standards relating to the company secretaries, we will certainly invite him. And he has given us a word that he will definitely come over because he can explain that to us in a very simple and easy manner to understand and the relevance of those accounting standards also. So I give a pause here and request Bala to take it forward. Thank you.
Yeah, Mr. Bala, 2-3 lines because we'll earn 300 people for us to start.
Good morning to all of you. I have a great pleasure in welcoming you all on my own behalf and also on behalf of Mehta and Mehta. Already panelists have said a lot about the topics. The only thing which I would like to emphasize here is we cannot remain aloof that we are not concerned with the accounting standard, accounting, etc. It is the job of the chief financial officer. Because our job is very categorically mentioned under the duties of the Companies Act. We are required to comply with all the requirements under the Companies Act. And financial statements also one of the compliances which is actually coming under the Companies Act, including the disclosure requirement. As Sudhakar already puts it, you may have the approval procedure, etc. under the Companies Act, but what is required to be disclosed, how it is to be treated, what are the things which are very important in accounting standard, he already cited the examples. So with this, I'll stop here. As we go along, these aspects are very well discussed in the presentation by Akshar, and we will take it up. And I request all the participants put their queries and so whatever they see clarification on the chat box, and we will address often whatever is there relevant at the time. And then at the end of the presentation is over, you can raise your hands and we can permit you to speak. I think I'll ask Akshar to take us through the presentation, please. Over to Akshar.
Thank you, sir.
One
Is my
small
screen-
submission before Akshar you go to the participants is that as panelists, whenever we are speaking on this topic, It is to set the tone, which is very, very relevant. It is not a wastage of time. Kindly don't treat like that. Please give us the liberty to have 10-15 minutes to talk about the subject, because as panelists, we have to set the tone, which is equally important. And I'm sure you all will appreciate that. Thank you. Yes, Akshay.
Yeah. Is my screen visible?
Yeah, very much.
Yeah.
Yeah. So good morning, everyone. Today's topic is related party transaction and disclosure. So we'll be covering the legal framework which covers the related party transaction in various acts like Companies Act, Income Tax Act, SEBI, and what kind of disclosure are required under AS 18 and Ind AS 24. So yeah, so in this webinar, we will be covering the base general introduction to the RTP, RPT transaction, then key component and the framework, various section of the Companies Act who speaks about the related party transaction, Income Tax Act, SEBI, LODR, accounting standard, AS 18 versus Ind AS 24. What are the major differences in terms of disclosures? Common transaction which we generally come across when we do the audit regard to related party transaction, few of the case study and major key role of the company secretary to give the proper transparency in terms of related party transaction. So what is related party transaction? So related party transaction is any arrangement, contract or transaction involving a company, its subsidiary, and individual entity with special relation, that is a promoter, key director, management, significant shareholder, or two parties within the same group where the ownership or control overlap. Such transaction can involve a goods, services, finance, or obligation with potential conflict of interest if not conducted fairly at the arm's length price. So why these regulations need to be regulated? So our panelist has already explained us that because of the conflict of interest that guard against the undue advantage and misuse of the corporate resources, regulatory oversight, multiple law, and SEBI income tax. NDS imposes the checks and balances to increase the transparency, and it is to protect the general stakeholders' interest so that their money doesn't use improperly with the related party transaction. So there are all acts are somewhere interlinked to each other. So Companies Act mainly covers it governs the corporate governance, prescribe the approval mechanism, and mandates the disclosure for the related party transaction. SEBI LODR regulation imposes the additional transparency which requirement on the listed entities to safeguard the investor and ensure the robust disclosure of the related party dealing. Income Tax Act main intention is to prevent the tax evasion by overcharging or undercharging the fees or any charges to the related party transaction. And accounting standards emphasize the more clear, transparent disclosure about all the related party transaction with regard to the amount, nature of transaction, parties, whether it is arm's length price or not, to provide the true and fair view to the stakeholders. So key component of the related party transaction framework is regulatory framework. Companies Act defines the related party under section 2, subsection 76 and subsection 77. It outlines the approval process via section 177. It gives 184, 188 and 189. SEBI LODR regulation 23 applies to all the listed company which specify the related party transaction policies and disclosure. Income tax section 40A subsection 2 governs the related party expense, preventing the tax evasion through artificial overdue pricing. Accounting standard AS under the Indian GAAP framework, and Ind AS 24, which is which is converged from the IFRS, gives the details like what transaction and which kind of transaction needs to be disclosed and how it should be disclosed. Transaction classified as a RTP under Companies Act, transaction like sale, purchase of goods, leasing, renting or availing of services, loans, or office of profit, underwriting of securities. Under AS 18 and 24, all related party transaction, even if no direct monetary exchange is involved, even only the agreement is involved, then too it needs to be disclosed. Companies Act give the approval mechanism, requires a board or audit committee's approval. In certain cases, shareholders' approval is also mandatory if amount is materially impacted. SEBI LODR put pressure on the audit committee to pre-approve all the RTP transaction, and if it is material, then shareholders approval is also required. Accounting standard do not specify any approval process, but it gives what how to disclose, what to disclose from the transaction taken place in the company. So if we go to the definition of the Companies Act, it says the related party means a director, key managerial person, and the relative, a firm in which the director, manager, or the relative is a partner, a private company in which director, manager, or the relative is a member or a director, a public company in which director, manager, along with the relative holds more than or equals to 2% of the paid up share capital, any holding subsidiary or associated company, any person, entity acting on the direction of the director or manager, excluding the professional advice. This is the definition given in the Companies Act, Section 2, subsection 76. Section 2, subsection 77 says the relative. The relative includes the spouse, parent, sibling, children, and lineal ascendant and descendant. It ensures the family ties that may create a potential conflict are disclosed. SEBI, there is a connection with the SEBI and accounting standards. SEBI defines SEBI definition also covers the promoter group, significant shareholder, and subsidiaries, and it also mentioned that whatever is covered under accounting standard is also part of the promoter will cover under the RTP. So regulation 2ZC from the LODR regulation
Just
gives a
1 minute,
definition.
1 minute, Akshay.
Yeah.
Go back to the previous slide, please. See, understanding the definition of related parties are very, very important because, as I said, I reiterate that it is the responsibility of the company secretary or his department to identify the related parties, whether they fall under the Companies Act, whether they fall under the listing regulations, whether they fall under the accounting standards. So identification of related parties is a very crucial part of compliances of this particular topic. I mean, this particular related party is concerned. So once he does that, they have to give this particular list to they have to share it with their colleagues. Several times this question comes whether this identification is to happen at the beginning of the year or at the end of the year. The answer to that is this, according to me, it should be reviewed, if not on monthly basis, at least on quarterly basis. During that particular interim period, there may be some related parties which might have entered into the list, or there might be some parties, they might have ceased to be related parties also. So review of related parties periodically is very, very important. As far as the periodicity is concerned, it all depends upon the size of the company, the kind of what's called as disclosures which are being given by the directors, by the promoters, by the KMPs. It all depends upon that. So identification of related parties is the first primary vital step as far as the compliances are concerned. Yes, Akshay, please go ahead.
Yeah, so as per the SEBI LODR regulation, the definition of related party transaction includes this, under the scope, it encompasses any transfer of resource, services, or obligation between the listed company or its subsidiary and a related party, irrespective of whether the compensation is involved. It includes all transactions specified in Section 188 of the Companies Act, which address to such as the sale, purchase of goods, leasing of property, availing and rendering of the services, appointment of the agent, office or a place of profit for the related party, but it also extend to those covered under the Ind AS 24 related party disclosure, including the key management, personal compensation, other transaction, and that goes beyond the scope of 188. So SEBI's definition is little wider than the given in the Companies Act. Section 177 of the Companies Act, the audit committee, the key highlight of that section is that it's applicable mandatory for the all listed company and certain large group of companies under the Companies Act 2013. The composition is given under that section with the minimum of 3 directors with the majority of being the independent director. Key function of the audit committee is to all the transactions should be pre-approved from the audit committee. The audit committee has to review and ensure that RTPs complies with the arm's length pricing, and audit committee should scrutinize all the intercorporate loan investment which may involve the RPT's aspect. The audit committee typically reviews the RPT transaction before the board grants the formal approval under the Section 188 of the Companies Act. SEBI LODR regulation requires the audit committee approval for all the RPTs in the listed companies. Income tax does not mandate any approval process, but if the audit committee and the board has done the proper studies and maintain the proper document for the arm's length price, and it helps us to prove when there is a scrutiny or something for the overcharging or undercharging. So these are it's a duty of the audit committee to ensure that RTP transaction rates at a proper arm's length price and disclosed properly. Section 184 says about the disclosure of the interest by the director. So it's a mandatory obligation. Every director must disclose any direct or indirect interest in the contract or arrangement involving the company. Form MBP1 is used to make this disclosure at the first board meeting of the each financial year or wherever there is a change in the director's interest during the year as well. A director who has an interest in the related party transaction must abstain from voting on the transaction if it is placed before the board under Section 188. If the transaction are not being disclosed, then there's a liability that undisclosed interest can lead to a director's personal liability for the resulting loss suffered by the company, and breach may lead to fine and even the disqualification for the directors if it deems so severe violation of the duty. So directors interested in RPT cannot participate in the audit committee decision or the board resolution concerning the transaction. This exclusion ensures the independent review and approval process of the related party transaction. Section 180.
Just 1 minute, 1 minute, Richard. Please go back again.
Yeah.
See, this 184 disclosure of interest by directors, it is a mandatory disclosure. No doubt about it. It is the responsibility of the directors to give the disclosure of interest and at the beginning of the financial year, as well as during the course of the year, as and when there are any changes are there. But as I told earlier, we should not leave it to the directors and simply take it, whatever the disclosures they are giving it. It is the responsibility of the company secretary to cross-check whatever the disclosures have been given at the websites of the regulators wherever possible. Say, for example, you can always go to the MCA website and you can cross-check the directorships, whatever the director has given to you. Sometimes it may so happen they might have become a director of a company, they might have forgotten to give the disclosure, or they might have resigned from some companies or ceased to be a director of some companies. They might not be giving the disclosure. So it is just as a company secretary, don't take it on the face value of whatever they are giving it. It is also equally responsibility of the company secretaries to also inform the directors that whatever the disclosures you are giving in case of any changes are there. Because on quarterly basis, it is always better to cross-check with the directors whether any disclosures they want to give it. This is a kind of a proactive or a preemptive action, I can say that. Because in case they are not giving the disclosures, if they are not complying with the section 198, even the directors may also have to vacate their office, if I am not wrong. That section 167, I think, gets triggered. Yeah.
Section 188 gives the approval and disclosure requirement. The scope of the RPTs is it covers the sale, purchase, supply of goods, leasing of property, availing or rendering any services, appointment to an officer or place of profit, underwriting of the securities. The board's approval, the approval mechanism is given under Section 188. It requires that all the RPTs within the interested director should be approved by the board, and the interested director should abstain from voting. Necessary shareholders approval is necessary if the RPT value is greater than equals to 10% of the company's turnover or net worth, as per the rule 15.3 of company's meeting of board and its power, which requires if the monthly remuneration of the office or place of profit also exceed 2.5 lakh. So that time a shareholders approval is also required. Also, it is required to be disclosed. RTP needs to be disclosed in the board's report in the form of AOC2, and register of contract MBP4 needs to be maintained under Section 189, recording the details of all the RPT transactions. Relevance with the SEBI and accounting standard. Listed company under the Regulation 23 of the SEBI LODR Act, and RPT is considered a material if it crosses 10% of the annual consolidated turnover of the listed entity, or meets other prescribed condition given in the regulation, such transaction requires shareholders' approval in addition to the audit committee's prior approval. Financial statements RPT transaction needs to be disclosed in the compliance with the AS 18 or Ind AS 24 for the full transparency.
Now, Sudhakar I have a question. Just go to the previous slides. See, it says, previous, which was the 10% wala? Yeah. So it says, if it is a crosses 10% of the annual consolidated turnover. Now, does it include GST and everything, or it is exclusive of GST?
See, it is not exclusive of GST. If I am not wrong, turnover, whatever you have reflected in the profit and loss account,
Yeah,
that figure is the turnover. And turnover definition is also there under the Companies Act. And according to me, turnover means it is inclusive of GST, not exclusive of GST.
Because many company there the GST is almost 18%, 20%.
It may be.
So if you talk about 100, but actually the company turnover is only 80 crores. I mean,
Sir, my answer to that question is what we are booking under the head of turnover in the financial statements.
That's excluding
It
GST.
is inclusive of GST only.
Atul,
So whenever
what
there are threshold limits are there, the threshold limits are to be considered. That, according to me, as a financial statements, whatever the figures we have quoted under that respective heads.
okay.
Pramodji, you have to say anything, please.
Yeah, Pramod bhai.
Okay, am I audible?
Yeah.
Yeah.
Okay.
So there are
Yeah.
so there are different views, Yeah.
No, okay. This is my personal view. As far as this filter of 10% for arriving at the applicability, the turnover, in my view, should be what it is given in the financial statements, what is disclosed to the general public in the financial statements of the company, which is excluding the GST, because GST is something which is not coming into the pocket of the company. It is an amount which is being collected as a liability from the customer and being paid. The difference is being paid to the government. So therefore, in my view, what will be considered in turnover is going to be excluding the amount of GST.
GST, correct.
But 1 minute, Pramod ji, ek baat batao ki in the turnover figure, what we are giving in the financial statements, are we giving inclusive of GST or exclusive of GST?
That is exclusive of GST.
So what I want to say is that whether it is inclusive or exclusive, whatever the turnover figure which is given in the financial statements, we have to take that only.
Exactly.
Am I correct?
Exactly.
Yeah,
And that is
what I
is
want to say. Whether it is exclusive of GST or inclusive of GST, I'm not concerned with. As far as the threshold limits are there, we have to go as per the financial statements.
उसमें खाली एक यही correction है सुधाकर जी कि the turnover which is given in the financial statement is exclusive of GST. So by default, GST is to be ignored for the purpose of determination of the threshold.
Yeah, correct.
Mr. Bala, you wanted to say something. There are many views on the charts.
I'll tell you one thing, really speaking.
Yeah.
Companies actually account the turnover as per the invoice value, what is billed to the customer. That is the thing. Because GST is whenever you go and buy a material comes not without the GST, without the GST. The ultimate price includes the GST, but only thing is the GST is to be borne by the people who are actually purchasing it. Company collects it and it refunds it.
Right.
And company doesn't account separately without GST with GST. Whatever the total invoice figure, that is what it is reported in the financial statements. See any of the companies you see, there is no bifurcation is made. It is the total invoice value what is actually billed. That's it. And again, the collection and other thing and all goes. Nobody says that 100 rupees I sold. It is 80 rupees only the sales value, 20 rupees the GST. I'm only disclosing 80. That doesn't happen at all.
Bala, the how the transactions are recorded, taking your example of invoice. So when the company will raise an invoice, for let's say 100,000 and 18,000 on account of GST and 100,000 on account of the basic price of the consignment. Now they are not going to record 118,000 as the income. They will credit 100,000 as income and 18,000 as the GST. So you will have two accounts getting credited. One is the income, which is for the basic amount of 100,000 and 18,000, that is the GST amount. So what is going to come ultimately in the financial statements of the entity is not 1 lakh and 18,000. It is going to be 1 lakh only. 18,000 will be set off against the deposit, against the GST that the company would have paid on the purchases, and the balance amount will be debited to the GST account when it pays to the government actually. So ultimately, what will reflect in the financial statement is going to be 100,000 only, and not 118,000. So the turnover will include only 100,000 period.
So we
Mr.
can
Bala,
conclude that whatever the turnover figure we are giving it in the financial statements, that is the basis which to be taken, because the regulator can never take that by whether it is inclusive of GST or exclusive of GST. Suppose if for any reason, if the company is booking the turnover inclusive of GST or exclusive, they have to take that figure only. Because, say, for example, earlier one question was there, in case of a trading company, so what they do, the purchases and the sales, if you see, the difference will be very marginal. That is only the profit markup only. That's it. In case of a trading company. So question has come up is by whether the trading companies, they have to take the turnover of the full amount or only the income. Whatever, suppose, say, for example, I'm purchasing a product at 85 rupees, selling it at 100 rupees. My turnover is 100 rupees or 15 rupees.
See, I'll tell you,
Obviously, the
Sudhakar.
question is you have to book the turnover, so you are booking the invoice value is your turnover. So you have to take the turnover figure as your threshold limit, not the marginal difference, which is your income, you can say. That's what my view is.
In the financial statement, what we show as part of the revenue, we show revenue, revenue. Now, what is the revenue? Revenue is something which is coming to the kitty of the company. So what is coming to the kitty of the company is only the basic amount and not the GST amount. GST amount is being collected as a liability, and the liability cannot be the revenue of the company. So therefore, in the financial statement, what will come as part of the revenue is only the basic amount that you have sold and not the GST. And then thereafter, you are right, because once you have done this, then you take the revenue as the basis for the purpose of determination at the threshold of 10%.
The participants are also mentioning the same way. The view is coming, GST is liability and it's a revenue, and that's why. So I think we can go ahead. So as mentioned, what is shown in the financial statement, as Sudhakar P said and Pramodji mentioned. Can we go ahead now?
Yeah.
Yes.
But the turnover which is shown in the financial statement are excluding of GST, right?
I think the same thing he explained in
Atul bhai, see, one minute. See, let us be very clear. Whatever the figure it is coming in the turnover head of financial profit and loss account or statement of profit and loss, you have to take that figure for the purpose of threshold limit.
Okay.
Right.
Let us not go whether it is inclusive of GST or exclusive of GST. As Pramodji is mentioning, the booking of turnover is always exclusive of GST.
Okay.
For any reason, suppose whether it is knowingly or unknowingly, if somebody is booking inclusive of GST, if it is coming under the turnover head, you have to take that as far as the threshold limits are concerned.
Oh, okay.
Okay.
Great.
So section 189 gives about the register of contract. So purpose is it serve as a statutory record for all the contract or arrangement in which the director is interested. What needs to be recorded under MBP 4 is a name of the related party, nature of relation, terms of transaction, and approval details. The register of contract should be kept at the register office of the company, and it should be open for the inspection by the member during the business hours. Why it is important? Because it acts as a central reference for every RPTs and their disclosure. Auditors and regulators can cross-check the MBP4 entries with the board meeting, AOC2, financial statement, and also it helps to maintain the compliance with the section India's AS18 and India's 24. SEBI LODR Regulation 15, Regulation 23, it defines a related party as a promoter and the promoters group, significant shareholder holding more than 10% equity, subsidiary, associate, and joint venture. Key provision under this regulation is audit committee's approval. Pre-approval is required for all the RPTs, including any modification during the year. Material RPT's threshold is whichever is lower of 1,000 crore or 10% of the annual consolidated turnover and must receive the shareholder approval with the related party abstaining from the voting. Omnibus approval is permitted for repetitive transaction of similar nature, which is valid up to 1 year with a periodic review by the audit committee. Significance, it ensures the protection to the stakeholders in the listed company. Non-compliance can lead to regulatory penalties and in severe case trading suspension as well. So this is the regulation 23 of the LODR.
So this related party transactions register has to be kept in all the board meetings, right? I believe it is at the shareholders meeting also one is to keep this.
What is that? I couldn't understand.
What is the question?
So the RPT register has to be kept at the board meeting also, in all the board meetings, and also at the shareholders meeting. So this register of related party transactions, which he just mentioned.
Register you're talking. No, register is to be placed only when you make the entry in the register.
Right.
That is to be placed at the next board meeting of the company, not in the shareholders meeting at all. Shareholders meeting only for the purpose of inspection you can take it. But as far as the board meeting is concerned, the directors who are present, they have to sign that register.
Right. So the point number 3, it says, it has to be kept at the register office. And this is open for the inspection by member during the business hour. Yeah, by paying some necessary fees.
Yeah,
Yes.
this is being a statutory register, Atul Bhai. Even the 1956 also it was there. The contract in which directors are actually interested. That is the name which was actually given also. So this is the same thing here, what we are talking before register. This register is one of the statutory register. It is required to be kept under the register office of the company. It is required to be updated on the ongoing basis as and when the transaction take place. As Sudhakar puts it, every quarterly meeting, whenever the company meets in the board meeting, it has to be actually placed there. So that what happens, the directors who are actually interested in the contract, they will remain neutral. Other people only who are against or for, that will be actually marked there. And again, it will be open for inspection for the members. And during the annual general meeting, it has to be kept open for the purpose of inspection if member want to inspect. That is the requirement.
Thank you, Mr. Pala.
Right.
So till we just had a view about the provisions of Companies Act, SEBI approval process given in the Companies Act. So once all the provision disclosures are maintained, now it comes. Now it will come to the accounting standard 18 and India's 24. So both standard basically gives about the disclosure of the related party transaction, but the scope and the area covered by both the standard is little different. AS18 is part of the Indian GAAP framework, and it focuses on identifying the related party transaction like directors, KMP entities under the common control, disclosing the transaction with them. It offers more domestic focus approach suitable for small companies which are not under the NDS. And India's 24 is little wider than the AS18 because it's a IFRS converged standard introduced as a NDS regime, broader in scope than AS18, covering extended relation, also close family member. It covers the government related entities, details of KMP's compensation as well. It emphasizes on materiality and global alignment, making Indian financial reporting more internationally comparable. Both standards aims to prevent the conflict of interest and protect the stakeholders by requiring clear disclosure of the transaction that could impact a firm's financial position in the performance. So to whom the Ind AS 24 and AS 18 is applicable. So wherever Ind AS 24 and 18, like all Ind AS will be applicable, and accounting standard is applicable. But we are specifically talking about these two. So main board listed company, if the company is listed on the main board company, then the Ind AS is applicable. SME listed company, Ind AS may not be automatically applicable unless its a net worth is greater than equals to 250 crore. And if it is less than 250 crore, then they can maintain the books under the Indian GAAP. Unlisted company having a net worth of more than 250 crore should go for the Ind AS, like they have to mandatorily adopt the Ind AS only. Unlisted company also net worth is less than 250 crore, then they can continue with the India normal accounting standard. Small companies definitely will be under Indian GAAP. Holding subsidiary joint venture and association of India's company. If any group entity is under the Ind AS, all group entities should also fall under the Ind AS only. So it's a group level Ind AS adoption which supersede the individual threshold also.
This table is so crucial. So many questions are asked in the chat box, and you are covering this many questions in this one table. Akshar.
Yeah.
So, see, this is very important. Nowadays, Indus, for an auditor, it has become so challenging. From the company side also, and for the auditors also. So, of course, all those chartered accountants, they will agree with me. Since the introductions of the Ind AS, in the audit, life of chartered accountant becomes so difficult.
Yes, Atul bhai, very right. And if I can add for the benefit of all of us, basically, when is Ind AS is applicable in general, and when is AS is applicable in general. So all the companies which are listed on the stock exchange main board or in the process of getting listed, whether for debt or whether for equity, doesn't really matter. Or the companies which are not listed, but whose net worth is more than 250 crore. To all such companies, Ind AS becomes mandatory. Ind AS becomes applicable. And all the companies to which Ind AS has become mandatory, their subsidiary companies, where their holding companies, whether listed or unlisted, their joint venture, their associate companies, also will automatically fall under the purview of Ind AS. So, those companies will have to maintain their accounts following the Indian accounting standards, which is an adapted version, not adopted. In Ind AS is an adapted version of IFRS, not the adopted one, I think. And all the other companies to which Ind AS is not applicable, Indian GAAP or accounting standards will be applicable. So this is the general, guiding line to know as to which company Ind AS is applicable, to which company Indian GAAP is applicable.
Okay.
Thank you, Pramodji. Very clear.
But Pramod bhai, if I'm a SME listed company and my net worth is just 20 crores and my turnover is only some 30-40 crores, so this is definitely applicable.
Yeah. So in case of SME listed, if you're simply an SME listed company, then of course Ind AS is not applicable to you. You still have to follow the Indian GAAP. But if your net worth is more than 250 crore, even though you are listed on the SME, if your net worth is more than 250 crore, then you will have to prepare your accounts as per the Ind AS, Indian Accounting Standards.
Okay, sorry. It is there in the point number 2. Yeah. Yeah, very informative this table, Akshar bhai.
Thank you, sir. Major differences between the Ind AS 24 and 18, AS 18. Both standards mainly focus on the disclosure of the related party transaction, but there
Sir,
are
you have to
some.
speak a bit loud. I think your voice is getting feeble.
Okay.
Yeah.
So there is a major this table lays down the major differences between two accounting standards, Ind AS versus normal accounting standard. Ind AS 24 is much more wider and practical approach than the Ind AS 18. So I have covered a few of them. So definition of the related party transaction. AS 18 defines a related party as those who are controlled by or has significant influence on the reporting entity, whereas NDS 24 defines a related party as a person or entity related to the reporting entity, covering the broader relationship. AS 18 has a narrow scope limited to significant influence and control relationship. AS 24, NDS 24 has a broader scope which includes the joint control, close family members, and entities under the common control. Close family member does not explicitly define in the AS 18. However, in NDAS 24, it is clearly defined as a spouse, partner, children, dependent, parents, and sibling. Control is defined as a ownership of more than 50% of the voting power or control over the board of director under AS 18. And the NDAS 24 defines the control which aligns with the NDAS 110, covering the comprehensive definition of control and joint control. Significant influence is defined as a ownership of 20% or more voting power or participation in the financial or operating decision. Under NDS 24, it includes a power to participate in the financial operating policy decision but not control, which aligns this NDS 24 with the NDS 28. Joint control is not covered under AS 18, which is covered under the NDS 24. Post employment benefit plan to the KMP, no, it's not or employees is not covered under AS 18. However, NDS explicitly mention and covers the related party if plans are employee of the reporting entity or related parties. In the AS 18 focuses on the disclosing the related party relationship and transaction. NDS 24 concentrates on requires a detailed disclosure of the relationship, key transaction terms, and outstanding balance as well. Example of related party under AS 18 is parent, subsidiary, associate, joint venture, relative of the KMP. And in the AS 24, examples are parent, subsidiary, associate, joint venture, close family member of KMP, entities under the common control, joint control arrangement, post-employment benefit plan. So the AS 18 is Indian specific, and it's NDS 24 is aligned with the global IFRS standards. Government related entities, AS 18 says that not explicitly covered. All the government, wherever there is a government company in which they have a transaction with other government entity, even though the amount is say 1,000 rupees or 2,000 rupees, they have to disclose. However, NDS 24 explicitly require disclosure of transaction if it's a material, not all the transactions. So there's a difference. Materiality is not explicitly discussed but inferred through the nature of significant transaction. The NDS 24 has given the clarity on the materiality is explicitly discussed, required disclosure if the significance to user of the financial statement. So if the transaction are not material, then just they have to mention the related party transaction name, and the details of the transaction not required to be disclosed. AS 18 do not speak about the disclosure in the interim financial statement. However, NDS 24, even in the interim financial statement, detailed RTP transaction needs to be disclosed. AS 18 does not explicitly recognize the substance over a legal form.
Atul, you should be on mute.
NDS 24 recognize the substance over a legal form in identifying the related party transaction. So basically both standards concentrate on the disclosure of the related party transaction, but these are the major differences between these two. Examples like a government related entity, AS 18, if a power generation company is a government company, they must disclose every transaction with the state owned coal supplier or whoever from they buy the material. In India, it exempts a certain government related transaction if carried out on a normal commercial terms, reducing the disclosure burden. KMP compensation. So in as per the AS 18, the disclosure of lump sum amount, say 1.5 crore paid to director. But as per the NDS 24, it requires the breakdown of that amount as well, like 80 lakh in short-term benefit, 50 lakh is the post-employment benefit. So AS 24, NDS 24 needs more bifurcation of the amount. AS 18, all the related party transaction, even the minor ones, must be disclosed. NDS 24 allows the materiality threshold. Truly insignificant transaction may not be needed separate disclosure. Post-employment plan. typically AS 18.
1 minute. So this point number 3, materiality. So if I'm an auditor, statutory auditors, which one I have to follow?
If
The
the
1 lakh
company,
must be disclosed or those materiality, no?
No,
So
it would depend. It
if
would depend
upon the
the
accounting standard
audited
applicable.
company. No. It would depend, Atul bhai, on the company that you are auditing. The company that you are auditing is covered under the Indian GAAP, that AS 18 will be applicable. And if the company that you are auditing is a listed entity for which Ind AS is applicable, the audit will need to be done as per Ind AS 24.
Okay. Yeah, please, Akshar.
Yeah. Ind AS 24 mandates the disclosure of the funding detail benefit paid outstanding liability for the company's post-employment benefit plan. Common transaction which cover across the various activities: sale, purchase of supply of goods, leasing, rendering of services, loan guarantee between the group companies, office of profit, licensing and IP transfer, where the royalty paid by the subsidiary for using the parent's brand, management contract, financial transaction. So these are the basic transaction which we come across in day-to-day business between the group companies. There's a note that even if the transaction does not crosses the Companies Act threshold for for separate approval, it is still required to be disclosed under the accounting standard 18 and Ind AS 24. So standard are more clear for the disclosure of the RTP transaction.
Just go to the previous slide. So sale means net sales, right? Sales return and all, it has to be deducted, right?
Yeah.
Yes.
Yes.
So loan includes those debenture instrument also.
Yeah.
Loan means all loans.
Borrowings.
Loans taken in any form is included.
So any NCDs or
whether convertible,
convertibles.
non-convertible, partly convertible, optionally convertible, everything will be part of the loan here.
The only thing, Atul bhai, you have to see that ultimately again, you have to go back to the financial statements only. Say, for example, if you are in the financial statements, definitely there will be, if they are covered under the loans head. Say, for example, FCCBs are there, till the time they are not converted, they will be shown as a loan only, no? That, of course, that nowadays, by that under the IFRS, if they are showing under the quasi equity, that is a different thing. Prabhuji, am I correct that if suppose, whatever the partly convertible or fully convertible, if you are showing it as a loan, it is under loan only we have to take it.
That is absolutely right, Sudhakarji. And number two, the question of the related party transaction will come pre the item reflecting the balance sheet. So before it is taken in as goes into the balance sheet, the related party compliances or formalities are to be taken care of prior to that, actually.
Okay. And the note is very important. It says, even if the transaction does not cross the Companies Act threshold for the separate approval, it may still require the disclosure in the financial statement. Okay. So irrespective of your Companies Act requirement, still, one has to disclose under the standards.
As far as the Companies Act thresholds are concerned for approval purpose, threshold is there only for shareholders approval. As far as the board approval is concerned, if it is covered under section 188, then definitely it requires board approval. If it is not covered under 188, it certainly requires audit committee approval. So every transaction with a related party, even if it is for a single rupee also, and in case if it is a listed company, that definition says with or without consideration even. So consideration is not important at all.
Right.
If it is a transaction with a related party, audit committee approval is required. If the transaction is covered under the 188, then it requires audit committee as well as the board approval. If it crosses the threshold limits set as per the rule 15, if I am not wrong, then it requires audit committee, board and shareholders approval also. This is under the Companies Act purpose. As far as the listing regulations are concerned, they talk about the audit committee approval and they talk about the shareholders approval. They don't talk about the board approval at all. So under the listing regulations, again, audit committee approval, every transaction with related party requires audit committee approval. Some subsidiary transactions also, if it is more than 10% of the standalone turnover, you have to go back to the audit committee approval of the listed company. Shareholders approval under there is concerned, there is no threshold limits there, but it said material related party transaction. So what is material related party transaction? There is a definition given in the listing regulations. This is what as far as the approval is concerned. Approval, yeah.
And to add a further point, the fact that there is no consideration itself is a good reason for this transaction to be examined.
I think if I am not wrong, as far as the listing regulations are concerned, the definition for the related party transactions, they have more or less imported from accounting standards only.
Atul,
just-
when it comes,
Not exactly, but yes. Not exactly, but yes.
They said, transfer of any services, resources, and with or without consideration, that wording, if you see, it is there in the accounting standards. It is not there in the Companies Act at all. Yeah.
Atul, as you rightly said, accounting standards are basically coming for the disclosure requirement. In fact, Sudhakar said in the beginning, whether you have the transaction or whether you don't have any transaction with the related party, all the related parties' name along with the relationship is required to be disclosed. And similarly, when it's come to the presentation of the financial, you might have heard the transaction done with the related party last year, current year, there may not be a transaction. But still, the last year transaction will appear in the last year's cycle, current year, that will not be there, but still, related party names and the related party relationship is still required to be disclosed actually. That is the whole point here. Because accounting standard is basically for the disclosure. Whereas the Companies Act or LODR regulation, they are all talking about the various approval mechanism and the procedure, etc., and other thing and all which is to be followed. As Sudhakar puts it, he really speaking, in the Companies Act approval may not be required in a particular transaction at all in the particular year. It may not be required at all. So you don't have to comply with it. But still, the disclosure requirement is there as per the accounting standard when you are making a presentation of the financial statements.
So I have a question here. So can you talk when you say what is the meaning of transactions? So tomorrow, if I'm doing some Christmas celebration with my group companies, and hundreds of employees from my group companies and my subsidiary companies, we celebrate. And as a company, holding company, I'm spending a lot of money. So is it that transaction which has to be disclosed here?
Okay, now Atul bhai,
Yeah, go ahead, Pramod.
Yeah, see, there are two things, Atul bhai. When it comes to related party transaction, it has to be tested from two perspectives. Number one, is this transaction is in the normal course of business? And number two, is this transaction is being executed at an arm's length price? So those are the two parameters. Now you will have to ask this question, this party that you are holding, for the purpose of group assimilation, with the subsidiary companies employees also joining in, and that's where you will have to see, is this transaction is in the normal course? Okay. And number two, is it at the arm's length? Now, as you know, as LODR or Companies Act, they always talk about the materiality. So you will also have to see as to the kind of expense that you are going to incur. Are these expense really material? And if they are material, then are they being distributed among all the participating companies in a very systematic manner, so that there is no iota of doubt in the minds of anyone that there is an attempt to siphon off the benefit to some particular things. So you got to look at from these two angles, and then you can come to the conclusion whether it is to be taken for approval or it is to be simply ignored and not to be treated as a related party transaction at all.
See, Atul bhai, to answer your question according to me is, what you say is that suppose, for example, any kind of celebration, if the parent company is doing it, where the subsidiary companies or associate companies are joined with, that means the group companies, employees are also joining. Is it a related party transaction? First and foremost thing, is there any transaction? So to have the transaction, what happens is that parent company, if it is raising a debit note to the subsidiary companies, to the associate companies, to the joint venture companies, by this is the cost what I have incurred on your behalf for your employees who have attended the party, then there is a transaction. Suppose they have been invited, but they have not raised any debit note and all, and the entire expenditure is incurred by the parent company only. It is not a related party transaction at all because there is no transaction as such. If you see, even in the listing regulations, if you see the related party definition, there is no transfer of resources, there is no transfer of services, there is no incurring any obligation also. So it is not a transaction at all. So since there is no transaction, there is no question of RPT at all.
To add further to what you have said, Sudhakarji, and this question that Atul has raised as a genuine one, and you are very right that as regards the participation of the employees and group companies, that is not a matter of concern. What is the matter of concern is the contract, to whom the contract is being given to execute this entire celebration. तो वो
Right.
जो इवेंट मैनेजमेंट कंपनी है, वो इवेंट मैनेजमेंट कंपनी कौन है, उसके वेदर दैट इवेंट मैनेजमेंट कंपनी उसके साथ में कोई रिलेटेड पार्टी है, तो फिर देन इट विल कम इनटू द एम्बिट ऑफ द रिलेटेड पार्टी ट्रांजैक्शन.
Yeah, Akshay,
We
no,
can-
just go. I just wanted to understand what is the meaning of transactions. I mean, so probably different people has a different no interpretation. But anyway, yeah.
No,
Good
actually, subsection 1 of section 188 of the Companies Act, it lists out 8 different kind of transactions. But my only submission is that it does not give an exhaustive list of the transactions for the purpose of related party. It only gives an indicative list actually. तो ऐसा नहीं है कि ये 8 में नहीं है, तो इसका मतलब मैं फ्री हूँ करने के लिए. It is just to give you an idea as to what all should be taken care of, when it comes to the related party transaction.
No, sorry. 1 minute, Pramod, it is not so. What 188 talks about is that 6 type of transactions requires a
of.
different kind of compliances.
Hmm.
That requires board approval and shareholders approval. Other than that 6 transactions, any other transactions, say for example, financial transactions are there, or transactions sometimes which may be without any consideration also may be there. So that's why I said that very clearly at the guidance note of RPT also, we brought the distinction between section 177 and 188. Just for the sake of understanding, let us call that 188 transactions are per se related party transactions, which requires the approvals of board as well as shareholders under 188. Whereas any transaction with a related party, that comes under 177. Whether it is mentioned under that 188 or not, every transaction with a related party, that has to come under the 177. So audit committee approval for every transaction with a related party and prior approval is also mandatory.
Okay.
At this particular point of time, I just wanted to add only one thing for the benefit of all the people who are present here. The Institute of Company Secretaries have brought out very excellent guidance note on related party transaction. Whatever Mr. Sudhakar talks about section 188, section 184, whatever it is, everything is actually spelled out with illustrative examples giving the things in the very clear, more understanding. I request all of the participants to please go through this excellent guidance note, which has been actually prepared with the expert people. That will actually throw a lot of light on this related party transaction understanding. Hats up to SSB board Sudhakar on this excellent job. I would like to say that.
Yeah.
In fact, not only that, for the information, many of the adjudication orders, this guidance note has been referred by the ROCs. They said actually the institute guidance note is saying this. The auditor has not followed this. The company has not followed this. They are categorically spelled out that also in many of the orders which I have actually seen it. So to that extent, the guidance note has been given the very importance actually. It talks about very highly. So please go through it. That will give a very good idea. Yeah.
Just wanted to make an announcement. If anybody wants to wanted to ask something, they can raise their hand and probably we'll take them, subsequently. Yeah.
Akshay, go ahead.
Bala sir, there are so many questions in the chat box. So if we can take it
Yeah,
up
we
that.
can address that.
Yeah.
We'll do that. We'll start doing that.
Yeah.
Okay. Yeah. I have noticed in so many companies disclose the names only those related parties whom they are having the transaction in the financial statement. I am the way to that the names of the nature of the relationship, all the related party required to be disclosed. Would request the panelists throw some light on this. I think you already spoke in the beginning itself. Whether there is a transaction or no transaction, it is required to be disclosed as per the accounting standards. That is very clear. Whether the transaction or no transaction, okay, that is right. Can we get the presentation copy? No, presentation copy is not being shared actually. The recorded webinar is actually disseminated at the YouTube. You can actually watch the disseminated webinar, which is actually there in the YouTube. Immediately after the webinar is over, it will be actually there. What is actually cut off the threshold limit is significant shareholders by related party. What is cut off threshold limit for significant shareholders to be related party?
To become a related party, there is no threshold limit as such. Even a single rupee transaction is also a related party transaction, provided if the transaction is with a related party. So who is my related party? You have to see the definition section.
Okay, somebody says, please guide about AS 124 IFRS. I think that we already taken care of. It is actually talked about it here. Or the cousin brothers and sisters are considered as relative.
See, again, the same thing. Who is my related party? Please see the definition. Forget about whether it is a cousin, sister, or a auntie, or uncle, whoever it is. You have to see the definitions only.
There is a difference in definitions of the related party between the companies and the accounting standard. Which definition is required to be prevailed?
Both. For the purpose of disclosure accounting standard, for the purpose of compliances, Companies Act.
If the company has not disclosed all the related party transaction in his financial statement, can we actually term is a violation of falsification of the financial statements, and whether it will involve 440 or 44B of the Companies Act and as such lapse? Yeah, in fact, there have been actually penal action has been taken for ROCs also. There has been n number of companies who have not disclosed. The penalties have been actually limited. Not only that, the penalty will limit even the chief financial officer and company secretary as well. There are n number of cases are there. It is definitely a violation. Whether the registered trust are required to be disclosed MBP 1. MBP does not envisage of the relatives, whereas the relatives, what should be done in the company's secretaries, decide to disclose the directors. Reading 189.2, MBP 1 also to be obtained from the at the time of the resignation. Is the board resolution enough to establish the arm's length? See, I think in the beginning only said the MBP 1 disclosure will be required at the time when a director joins the company. And again, regularly at the ongoing basis, any changes which are taking place, as and when the changes take place, it has to be given. He talked about the register also, the maintenance of the register, showing the RPT relationships, etc. That is actually talked about it. That is one thing. Second thing is that MBP 1 also to be obtained at the time of resignation.
I think, see, that MBP doesn't envisage disclosure of relatives, interest of relatives. What should be done as company secretary? I think if I am not wrong in MBP, different MBP 1, you have to disclose the relatives list.
Yeah.
And who is my relative? It is already defined under section 2, subsection 78, I think, if I am not wrong. And relatives, you have to give it. Now comes to the reading of 189.2, MBT also obtained at the time of resignation. What is that MBP 1 also to be obtained at the time of resignation? Reading 189.2.
I don't know MBP 1 to be obtained at the resignation, because MBP 1 is the ongoing disclosure which is actually there. It is given in the beginning.
1 minute. See, MBP, if a director is resigning at any point of time, any companies, he has to disclose it to the company. No doubt about it. Earlier it was within 21 days. If I am not wrong, now it is within 30 days. If I am getting appointed, say for example, MBP 1, I have to give it in the beginning of the financial year. After that, during the course of the year, any changes are there, I have to give it. Suppose, for example, I ceased to be a director, I resigned as a director from a company, or I got appointed as a director in another company, I have to inform to the company, wherever I am a director, within 30 days of that thing. That time limit, I'm not very sure If I am not wrong, earlier it was 21 days, now it is 30 days. Okay. Whatever the time limit is there. What is the purpose of giving this kind? Similarly, the change in the relatives definition. Suppose, for example, if my son or daughter got married, and again, if I am not right or wrong, their spouse is covered under the relatives definition. So that point of time, what happened is I have to give the disclosure of interest as and when that marriage has solemnized. What is the reason for that? Because MPP1, based on that, the company secretaries are going to arrive at the related parties. Under section 2, subsection 77, if you see that related party definition is there, one of the sources to arrive at that this thing related party list is MPP1 only. So during the course of a year, any changes are there, you have to bring that thing. Now, fourth question, is the board resolution enough to establish arm's length? Board resolution is not going to establish the arm's length. Arm's length, it is the company which has to establish it. Suppose if I am a regulator and tomorrow I am coming for the inspection purpose or investigation purpose, and if you are taking the transaction as an arm's length transaction, you have to establish that. So how you will establish that? That yet actually is about to reach to that particular point of time, and he will explain it how to reach that arm's length transactions and all. He is going to explain to that. Yes, Bala.
In AOC 2, right to material is RPTs.
What is that?
In AOC 2, it is right to material RPTs.
I think it is question or answer. We don't know.
I don't know.
Okay.
Only for the purpose of the clarity, I can say that AOC two type of transactions are to be furnished. One is that the transactions which are not at arm's length basis. Okay. That means you are not taking the exemption, ordinary course of business, arm's length basis and all. So you are taking the exemption under 188. So you have to give the transactions which are not on arm's length basis, means which you have to make an entry in the register of 189 register, you have to make the entry. All those transactions you have to give under this column. The second type of transactions are transactions which are on arm's length basis. That means you have to give both the type of transactions which are on arm's length basis, which are not on arm's length basis. This is what precisely you have to give it to AOC 2. And what sort of transaction, the name of the party, the amount of the transaction, the type of transaction, all those details are there in the section or rules that is to be given.
Private company, interested director need not abstain if he is actually disclose the interest. Please correct. This is correct.
What is that? Again,
private company, interested director need not disclose if he has already disclosed the interest. Need not remain need not abstain if he has actually disclosed the interest.
Mr.
He's talking about voting process.
In PPT. It is not somewhere in PPT he says that corrected.
I see.
Yeah.
Okay. If one RPT transaction is required to be passed by the audit committee as well as the board meeting, then how will get actually approved? Maximum directors would be interested. If the maximum director is interested. If the maximum director is interested, automatically it will go to the shareholders' approval, no? Isn't it, Sudhagar?
Yeah, correct. See, one thing is there, you have to create the disinterested quorum, or alternately, you refer the matter to the shareholders.
I think next all the things are we are talking about.
Mostly what happened is this happens only in case of private companies or closely held public companies, where appointment of independent directors is not mandatory. Where the appointment of independent directors is mandatory and listed companies, this sort of question doesn't arise. Always you will have a disinterested quorum.
Okay. Next all the things, I think it is talking about the turnover business, which we discussed elaborately. I think I will not take these things. These are all again turnover. Somebody is actually sharing the things. That is, ABC is actually a chartered accountant firm. Part of the firm also the major shareholders in another company name limited, Mr. ABC is actually appointed the auditor of XY Limited. Whether any transaction is between the firm or the XY Limited, fail to understand. What is that? The ABC is a chartered accountant firm. Part of the firm also the major shareholder in another listed company named, what is that the name? Element Limited. So Mrs. ABC is actually appointed as the auditor in XYS Limited. Whether any transaction in between the limited company and the XYZ Limited falls under the RPT.
See, I don't know how the related party can be appointed as an auditor.
Cannot,
It is a
they cannot
conflict of
be.
interest.
It
I
cannot be.
think that is not permitted if I am not wrong.
Yes.
The question is slightly confusing.
If
I
auditor
think-
has, if auditor has any financial interest in the auditee, proposed auditee,
Yeah,
he cannot be appointed as the auditor of that firm.
he
Because
disqualified.
this-
Yeah.
Yeah, he is disqualified.
The question is the auditor of one company is holding majority shareholder in another company. Whether the transaction between this company, where he is an auditor and where he is a major shareholder, is RPT. That is the question.
Deepti, that is what Pramod is saying, that if you are having a shareholder, if you are a shareholder of more than rupees 1,000 face value, you are disqualified. If it is
Yeah,
relative.
you should
Yes.
be
He
you
is
should
not
be
a shareholder of auditee company, of another company. I am auditor of A Limited and I am holding majority shareholder in B Limited. Whether the transaction between A Limited and B Limited is RPT. That is the question.
Auditor is not a related party. Okay,
Yeah.
if he is falling in the definition of related party of that P Limited, then you have to see that.
Yeah.
Okay.
No, here the question it appears to be he is holding the shareholder, he is appointed the same company. That's what it appears to be here.
No.
If that is the case, he becomes actually not an independent auditor.
See, anyway,
Yes.
that the participants have to put the question clearly. We should not go for interpretation of the section, the question itself.
Okay. Somebody is actually sharing it. Our purchase and sales always include the GST. This is what it is. Anyway, we
That is
discussed
okay.
enough on this. Okay. If disclosure is actually being given in the beginning of the year, which turnover is to be calculating 10% taken just for the previous year of which, what is it? If disclosure being given in triggering of a year, which turnover for calculating 10% to be taken previous year or whatever it is. That means he is talking about the 10% disclosure, how it is to be calculated in between the year. Whether it is as per the last year's turnover or in the current year, that's what I think so. He is asking.
Yeah, this is going to
Mentioned
be
it is the 10% of turnover as per the latest audited financial statement.
right. That's correct.
Okay.
Yeah, Mr. Bala, you missed one question. I'll read it out. If the company was listed during the year and the company has crossed 10% of the RPT transaction at the time of listing, what should the company do? That is the question.
If the company is crossing the threshold at the time of listing, so ideally okay, so after listing, so at the earliest opportunity, the transaction will need to be approved.
Or see, it should be before you are entering into the transaction. Let me be very clear, because even on Regulation 23 talks about prior approval of the audit committee. Okay, the moment you are actually envisaging that this threshold you are going to cross, before you are crossing the threshold, you have to have the audit committee approval in place.
Yeah.
Please clarify the abstaining point.
What is that?
No, leave it.
Please clarify on the abstaining point. I think abstaining point means not to participate in the voting, no? Interested people?
See, abstaining means it's not like that. The person who is interested, he is abstaining. He has to recuse himself. Abstaining means a person who is having a right to vote, he is not voting in either way. He is abstaining. He is not casting the vote. That is what the abstaining means. An interested party, he cannot abstain. He has to recuse.
So not only
In,
voting, but also in the participating in the discussion on that particular item.
Yeah, that's what I called as recusing himself means the same thing. Neither he will
Yeah.
participate in the discussion nor in the
Nor
voting.
vote.
Yeah.
in case of the wholly owned subsidiary, whether any board approval required for the RPT, 100% shareholding with the parent company.
See, the exemptions are there both in 177, 188 for wholly owned subsidiary companies, provided the accounts are getting consolidated.
Or either simply board resolution is enough. That's what your same question is.
Yeah.
Okay. 189 register is over and above the section 188. Is it covering the transaction which are covered under section 184(2) as well as, or what is your view, Sudhakar sir?
Yeah, see, that 189 has nothing to do with 188. 188 might be exempting you from the taking the board approval and shareholders approval, but still you have to make the necessary entries in the 189. Similarly, 189, there are two parts are there. One part is 184(2) is concerned. So whatever the disclosures are there, you have to reproduce that. There is a part A and part B is there. Now, one part of it is concerned with the 188. If it is not in the ordinary course of business, it is not on arm's length basis, and you are taking the board approval and all, then you have to make the entry in the 189 register.
Next one reads actually no AVC2 is applicable question mark. I'm not able to get it what exactly is saying. Because the message which is appearing here is no AVC2 is applicable question mark.
So leave it. The question
Yeah,
is not
go
clear.
ahead.
Leave it. Leave it.
Okay.
That's not,
He can speak when we allow. Okay.
Anyway, AOC2 I have already answered, Bala.
Okay, if the director do not disclose their interest correctly in MBP4, what is the responsibility of the professional?
See, in fact, if the director is not giving proper information on MBP4, it leads to his disqualification. Sorry, it leads to the vacation. If I am not wrong, 184, if the director is found lacking, 167 gets triggered. So
Okay.
that is the reason actually what I said is it is a responsibility of the company secretary to guide the director concerned about this thing. Not only in the beginning of the financial year, but on quarterly basis, sir, is there any change from the last disclosure what you have given to you?
No individual is holding 2% or more shareholding in both the companies. That means what is the question? No individual holding 2% more shareholding in both the companies. Okay. Only at audit committee or board meeting. I'm not able to get this question actually. Suppose the transaction with the yeah.
Time I know when it is that when it was asked where the register of contract to be kept.
Okay.
Then he is adding the comment.
Okay. Suppose a transaction with the company, which is not actually related party, but the director is actually holding 2.5% shareholding and covered under section 184(2) and required to be actually report under the register in section 189(2), and the same has to be placed in the next board meeting and required to be signed by all the directors present.
The entry in the register of 189(2), it is to be signed by the next board meeting. It is to be signed by all the directors, except the directors who are attending through video conference. That you have to mention there. The people who are attending the video conference, they don't need to sign. You can mention there they attended the meeting through video conference.
Many companies actually maintain the register on the electronic form. They are permitted under the law. How to actually comply with the signing of the register and the director requirement in such cases?
Digital signatures.
Register MBP4 needs to be placed even there is no such a transaction where directors are interested.
Come back again.
Register MBP4 needs to be placed even if there is no such a transaction where the directors are interested.
So if the transactions are not there, I think he's not talking about 189(2) register only, if I'm not wrong. If the transactions are not there, you don't need to place it. But
What are
before
the
the
threat-
shareholders at the general meetings, you have to place it for the purpose of inspection.
What are the threshold limit above which AS 18 is applicable in companies? I think he has already put it in the slide.
Yeah.
Whether the transaction between subsidiaries and subsidiaries is also required to be disclosed. Subsidiary to subsidiary.
Yeah, you see, under the listing regulation, now what's called as cross transactions are also fall under the related party transactions, so they have to be placed.
In case of the omnibus approval taken in the beginning of the year, the arm's length cannot be proved at that time, but only when the transaction takes place.
See, at omnibus approval is concerned, only audit committee can give the omnibus approval under the Companies Act. Board cannot give it. And as far as omnibus is concerned, whether it is at arm's length or not, audit committee has to give its approval. Okay.
For Section 8 company, yes, Pramod.
About the omnibus approval, the audit committee can give the approval provided it is in the normal course of business and it is at arm's length. If either of these two conditions are not being met, then the audit committee cannot give the approval.
No. 1 minute. Sorry, Pramod. Audit committee approval on omnibus basis is only for the transactions which are recurring in nature. For one. Number two, the transactions which are of revenue in nature. Capital transactions cannot be given the approval by audit committee on omnibus basis. So as far as the omnibus transactions are concerned, it has nothing to do with the ordinary course of business and arm's length is concerned. That is only for the purpose of 188.
Yeah, it is actually the repetitive nature of the transaction for which the omnibus approval is actually given.
So that means what one-off transactions cannot be given on omnibus basis.
No, but what
cannot be given on omnibus basis.
What is the query, Bala, precisely? Maybe I missed part of the query.
No, in case of the omnibus approval taken at the beginning of the year, the arm's length cannot be proved at that particular time, but only at the time of the transaction takes place.
So this query does not talk whether it is a recurring transaction or one-off transaction.
No. The moment you say omnibus approval is taken, omnibus approval is given only for the repetitive nature of the transaction.
Correct.
No?
So exactly. So the approval, if it is given, it is assumed at the time of the grant of the approval that this is a recurring transaction, and this is also at arm's length. Now, this is a twist that the arm's length can be decided only at the time of the execution of the transaction. Whether the audit committee will be authorized to approve such a transaction, I have a question mark.
As I informed, arm's length has nothing to do with the audit committee approval. Whether it is an arm's length basis or whether it is not an arm's length basis, whether it is in the ordinary course or not in the ordinary course, audit committee has nothing to do with that. Audit committee has to approve the transaction if it is a transaction with a related party. That is what 177 talks about. And as far as omnibus is concerned, omnibus is only for the transactions recurring in nature, revenue transactions, not one-off transactions, not capital transactions.
Actually, Sudhakarji, as regards the omnibus approval is concerned, it has got nothing to do with the Section 188. It is provided only in the regulation LODR, in LODR, not in 177 also. So it's only LODR that talks about the omnibus approval.
No. 177 it is there.
Is there?
Yeah,
okay.
It is there
177 it is there right from the beginning. Omnibus basis, that regulation 23, it has come only now. It was not there earlier, even in regulation 23. It was only come now. Yeah.
In fact, I agree with Sudhakar. Omnibus approval is only in the repetitive nature of the transaction, irrespective of arm's length or no arm's length. There is nowhere it is talked about the arm's length. It is only the question of the repetitive nature of the transactions.
Yeah.
First, yes, somebody is saying something.
I think, Bala, let us go ahead with the presentation. Then you can put the remaining questions, I think.
Yeah.
Okay. Yeah.
Now complete the presentation, Akshar, and then we'll take it.
Yeah.
Okay.
Correct.
Yeah. So these are the common examples, which we notice every time that promoter, we get some offices or places on the lease from the promoter. So what we need to see
Akshar,
is
you have to gallop because it is 12:40 already, huh?
yeah. I'll
Okay.
So promoter leases the office space to the company. Then, as per the Companies Act, we needs the board's approval plus potential shareholder approval if it is a material. If the transaction was not at arm's length, it could be violation of Section 188. SEBI LODR perspective, it's a listed company. The audit committee might flag it as a non-arm's length price, and they have to approve it and check it. So, as Sudhakar sir said, what's the arm's length price, how it can be determined. So, Income Tax Act says about some methods, via which we can confirm whether the transaction is an arm's length price or not. So, it says about the comparable uncontrolled price, like if the same.
Akshar, let me just interrupt for a second.
Yeah.
Sudhakar ji, I draw your attention to second line of the Companies Act. Would you like to make a comment on this?
Transaction was not at arm's length. It could violate Section 188. Yeah, where is the violation? There is no violation. If the transaction is not at arm's length basis, it has to comply with the 188 provisions. Okay. So what it says, Companies Act needed board approval plus potential shareholders approval if it is material. It is actually, see, the materiality is not there in the Companies Act. The threshold limits, if it cross the threshold limits, which are mentioned under Rule 15, it is the suppose 10% of net worth or 10% of turnover, whatever it is there. And if the transactions are in the ordinary course of business and at arm's length, then it doesn't require 188 approval at all. That is the exemption given in 188. So there is no question of violation. Only thing is, if it is not in the arm's length basis, you have to go to the board. And in the board also, what they say is that transaction is to be approved by the board only at the board meeting. And unanimous consent of the directors present at the meeting is required. It is not that simple, what's called majority resolution. All the directors present has to approve that related party transaction, which is not in the ordinary course of business or arm's length. And you cannot do a circular resolution also. And this also requires the audit committee approval. Whether it is ordinary course or arm's length or not, that exemption is only for 188 purpose, not for the purpose of 177. And 177, you can pass a resolution by circulation. There is no legal prohibition for that. Though governance point of view, it is required at the audit committee because a proper discussion is required. They cannot pass that thing by a circular resolution, but legally it is permitted.
So basically what we are saying is that audit committee, if the transaction is at a arm's length, the audit committee still has to approve it so long as it is in the normal course of the business, repetitive
Correct.
transaction.
Correct.
So audit committee does not have to worry about the arm's length aspect of it.
Yeah.
Correct. That is right. Absolutely right.
Okay.
Yes, Akshar, go ahead.
So for the arm's length price, income tax gives a few method under Section 92. It's like comparable uncontrolled price, resale price method, like the same price is being charged to somebody else, cost plus method in which the costing of the product or thing is arrived to see the transaction is it's an arm's length price or not. So these are the methods given in the Income Tax Act to confirm whether the transaction are at arm's length or not. Accounting standard AS 18 says about the disclose the nature of the relationship, terms of the lease, amount paid or received, or any outstanding balance. In addition to the accounting standard 18 covers India's needs further disclosure whether the terms are at arm's length or not, key contractual details, any impact on the financial performance of the company due to this arrangement. Further, the common transaction we see is unsecured loans to subsidiaries. So here also parent company repeatedly grants unsecured loans to a subsidiary with no clear terms of approval. Then it could be again a violation or of the Section 188 or plus Section 186 of intercorporate loans will also get attracted. Boards and shareholders approval might be needed. Audit committee must approve if it's a listed company. And income tax also, assessing officer may challenge the transfer pricing interest, whatever we are charging. And the same accounting standard 18 and Ind AS 24 needs a more detailed disclosure of the relationship, key terms, expected credit loss, interest charge, everything. So these transactions are mostly common that we see, and we need to disclose the more detail as per the accounting standards. So Companies Act disclosure are required in the form of AOC 2, MBP 4, in the financial statement, Schedule 3, RPD transactions separately. And the purpose of these disclosure are for the stakeholders awareness, so that they will be aware about the transaction they are entering into. As per the SEBI LODR, quarterly report needs to be published with the RTP details, especially if it's a material or deviate from the policy. It must disclose the material RPTs with amount and parties involved. Also highlight the justification if needed. Material threshold is 1,000 crore or 10% of the annual consolidated turnover. Over and above that, extensive justification and shareholder approval may be required. If it's a violated, SEBI can impose a fine, or they can request a restatement of the financial statement if disclosure are not properly or misleading. Disclosure requirement under AS 18 and 24. So both accounting standard, one is Ind AS and AS 18, gives some guidelines to disclose. It's details of the related party, names, nature of relationship, transaction types like sale, lease, service loan, amount, terms, outstanding balance, whether receivable, payable, loan given, received at the end of the year, provision for doubtful debts if relevant, materiality. If the transaction is large or critical to understand the company's performance, it must be separately disclosed. And these are the criteria given in the accounting standards. So it's just an analytical approval process.
Just one minute, Akshay. Recently, somebody asked me a question, Moji, that there is a related party transaction which got approvals and all those things. Ultimately, they entered into. And it so happened that particular debt has turned out to be a bad debt. Now the company wants to write it off. So they ask, is it a related party transaction? Okay. So writing off a bad debt, which is of a related party, whether it is a related party transaction or not. That is the question. So my answer to that was, it is not a transaction falling under 188, and it is not a transaction falling under Regulation 23 also, because it is not a transaction with a related party. So even 177 also is not required, because this is the transaction, whatever the approvals are required, you already taken that. Now it is only, what is the transaction? Writing off is a transaction. That's it. So according to me, this particular transaction is not a related party transaction. No approvals are required. This is what my personal view. I thought I will share it for the benefit of everyone. Am I correct? I mean, you may also say, Bala, you also can say that.
Promote your views.
Slight difference on this, Sudhakar ji.
Is also
Am I audible?
Yeah.
Very much, very much.
सुधाकर जी थोड़ा सा डिफरेंस है मेरा इसमें कि राइट ऑफ whether the write off is a transaction or related party transaction or not a related party transaction. Now see, you are writing off a debt which is due from a party which was a related party earlier with you. So when you gave the debt to that party, it was a related party. Now that you are writing off that debt, obviously the writing off has to be approved by the board in any case.
That is true.
Now, in my view, it still remains to be assuming that all the other parameters of related party transaction that existed at that point in time, they continue to exist now also. Assuming that to happen, in my view, it is going to be a related party transaction. It is, in my view, on the contrary, it is a serious related party transaction because you are writing off debt due from a company which is a related party with you. So I would feel it is a related party transaction, and the due process should be followed in this case.
See, what is the case? What I'm trying to say here is, this is a transaction. See, what is a related party transaction? If there is a transaction from the company's side, for any transaction, there are two people are required. One is the company and second one is the other party. If the other party falling under the definition of related party, then it is a related party transaction. When you are writing off a debt, you are not entering into a transaction with any second party. It is only a
That is-
simply you are writing off a particular debt. So that
Sir-
requires board approval. That is a different thing.
Sir, in
Certainly,
my
it
view,
requires a board approval. But what I'm
yes.
trying to say is, and similarly, in some companies, what they do is when they are writing off the bad debts, they route that through the audit committee also. Because anyway, anything financial related, it has to be routed through audit committee. So
Audit
audit committee
committee.
has to approve bad debts.
Yes.
Board has to approve bad debts before they are writing off in the financial statements. Only thing is, what I'm trying to say here is, you in that particular resolution, you don't need to refer to section 177, you don't need to refer to section 188, or you don't need to refer to regulation 23. That is what my precise point. That's it.
Sir, let me ask this question differently. If this party was not to be a related party, right? If it was to be a normal debt, okay. If this was to be a normal borrower or normal party to whom you would have lent the money, obviously you would follow the due process कि ये party है, this party को आपने loan दिया और नहीं वापस करने वाली है. These are the circumstances and therefore it's not possible and therefore we need to write off. Now that simile, if you apply here, it becomes even more serious because then you will have to give more disclosure that the company had given a loan.
As far as disclosures are, 1 minute, as far as disclosures are concerned, you will give disclosures in the financial statements as far as the writing of the debts are concerned.
From whom?
So
Related
you are
party?
not going to
one
give
second.
this particular disclosure. 1 minute, Prabodji, what I'm trying to say is, the writing of a bad debt pertains to a related party. You are not going to give it in the related party transactions list. You will give it separately.
So we discussed in the beginning, any party who is a related party will have to be disclosed in the financial statement, whether we have a transaction with that party or we do not have a transaction with that party in that year. So in the financial statement that we would give the disclosure, this party would continue to reflect as a related party. So when this party continues to reflect as a related party, we will have to give a disclosure saying that the company had given a debt to a related party by this name. This company's debt has been written off by the company. So when you are referring that disclosure as a related party disclosure in the financial statement, that you have to, whether as per AS 18 or Ind AS 24, so the same thing will have to be followed. In my view, definitely, considering that this write-off is to a party which is a related party. So the due process, in my view, will need to be followed. I mean, this is how I would look at it.
See, as far as disclosure is concerned, I have no dispute at all. You have to give disclosure in the financial statements.
Yeah, when you give the disclosure,
I am talking about compliances part. Compliances, when I'm talking about, is under 188, under 177, under regulation 23. Whether that compliances are required, do I need to mention a entry in the register? Do I need to say in the ordinary course of business, arm's length? All these will not come. That is what I'm trying to say. No doubt about it. Board approval is required. Audit committee approval is required. Disclosures are required. Not under these three regulations, sections or regulations, whatever you may call. That is my precise point.
Sudhakar, I agree with you 100% with you. It is not the related party transaction at all at the first place. Because whatever related party transaction already taken place, all the procedural aspects, approval, everything is compliant with it. We have reached the stage, the money is to be repaid. The question is that has become debt. Whether related party, no related party, it is the board has taken a decision, the money is unrecoverable, it is to be returned off. Yes, to that extent, yes, the justification, the disclosure, etc., financial statement disclosure, writing up about the default, that all will happen. But there is no related party transaction at all on this matter. I agree with you 100%. I beg to differ with Pramod.
No problem.
It's always good. The panelists are different to each other.
Absolutely, we can, of course, and rather we should actually. Otherwise, there is no fun.
And we can look at the comments. Comments are also coming. It is with the majority is telling it is RPT. So, just for information purpose, in the chat, lot of comments are coming. To respect that comment, I'm telling majority chat is telling that it should be. So with that, we can take ahead the presentation. If
Yeah,
Go ahead,
I
Akshay.
Yeah.
we are
So
already
this is
closer to the time. I think Ashar, you'll have to close it. Yeah.
No. We will not push him actually.
Yes.
People are also writing that go slow. So yeah, we will take it now cautiously. Yeah.
Yeah.
Yeah. So there is a approval process given into the Companies Act and SEBI LODR. Like Companies Act specifically says about the board's approval, audit committee's approval, and the SEBI also says audit committee plus shareholders approval. Disclosure are made as per the Companies Act in AOC 2, MBP 4, and financial statement. Additionally, in LODR, it's a stock exchange filing in annual report. Threshold and the penalty consequences are given as per the Companies Act, SEBI. Income tax do not specify any approval limited, etc. But they do take the transaction from the financials and they identify whether those transactions are at arm's length price or not for the purpose of calculating the tax liability. Companies Act gives a penalty if there is a violation of Section 188, and if it's a listed company, then it can be there will be fine up to 25 lakh. Other entity, the range is from 25,000 to 5 lakh. Director and officer in default is liable to pay additional penalties, including the personal fines, etc. Penalties and non-compliance under income tax and SEBI. So income tax will disallow your expenses if it is overcharged, and they can add to the income also if it's under billing to the related party transaction, and they can add it to your sales as well, and they can change the tax liability based on the transaction. SEBI can impose the fine based on as per the regulation 23, ranging from 1 lakh to 1 crore for the failure to obtain the prior approval of the obtain the required approval for the RTP or disclose the RTP in the financial statement. They can send in the notice and they can instruct for the financial restatement, etc. They can also, SEBI can also do a trading suspension for the companies if there is a violation. Best practice to manage the RTP is like, as Sudhakar sir already mentioned, that it should be a regular training, there should be regular awareness, maintain the master list of related party transaction, keep the benchmarking pricing to compare whether it's a arm's length price or not. There should be a proper approval workflow for the approving all the related party transaction. Whenever there is a related party transaction, all the transactions should be properly recorded and kept documented in the form of MBP 4 and in the board minutes, AOC 2, and the proof of valuation or arm's length price. Periodic internal audit to focusing on the more on RPT compliances, red flag the transaction which are repeatedly or unexplained link pattern. Independent director oversight, it should be bring to the notice of independent director. They should also approve it. In alignment with the Companies Act approval, SEBI disclosure, income tax arm's length price, and AS 18 and NDS 24 reporting into a single RTP policy. So these are the best practices, as we can deploy in the company to properly comply with the RPT transaction. So it's a illustrative disclosure how the RTP transaction are disclosed. Like we have to give the transaction, then the party relationship with the party, amount, approval status, whether it's arm's length or not, like means valuation have taken, it's at market rate. So this can be proven like that. There is another transaction of loan management contract. So same this table, we can follow the same table and we can make the disclosure accordingly. And auditor can get this party's name from the MBP 1 and AOC, MBP 1 and the AOC, MBP 4, AOC 2, and from the MBP 1 as well. So these are the detail from where he can derive the related party transaction. Also, they can ask the directors to disclose further parties where they are director or their relative is director, and then they can check with the financials to report the transaction. So key takeaways, like there are major Companies Act, SEBI, income tax and accounting standard who covers all the RTP transaction process, disclosure, approval. Compliance is interested through audit committee, board, shareholder disclosure, then proactive governance. So it's a major key takeaway, that it's a conclusion that these are the act and the standards which speaks about the RTP, gives the guidance that how it should be taken, how it should be recorded. So we'll take two case studies. Out of that is the PwC versus Satyam Computer. So in this case, what happened was there was a lot of related party transaction where the money was routed through those companies by inflated prices. So in 2009, Satyam Computers admitted to have a massive accounting fraud by the chairman Ramalingan Raju. Although the primary issue was a falsification of financial statement, but subsequently investigation also flagged the irregularity of the related party transaction. So PwC was found to have failed in detecting the large-scale fraud, including the RPT transactions. And SEBI debarred PwC for to do the audit of listed companies for 2 years. ICAI has also taken some disciplinary action against them. The in the report which was issued, in that there was no specific mention of the CS, but this SFIO and MCA has reported that there was a weakness in the secretarial compliances and the board processes with regard to the approval of the related party transaction, because of which the PwC was also not able to identify the related parties, and ultimately it reaches to this fraud transactions and it came out. Even the ILFS 2018, it's a entities infrastructure leasing finance services. They have made the default of 91,000 crore debt due to the poor governance and concealed related party transaction. Key issue was loans and guarantee given to the group entities without proper disclosure, non-arm's length transaction, and hidden financial obligation was their lack of transparency in the financial statement and governance labs. And because of all these things, the real transaction could not be reflected as per the AS 18 and India's 24, and it failed to capture the related party transaction relationship, and this also happened. So in the same case, the NAFRA took the action against the auditor. They replaced the key manager person in the company, and also SFR in NCLT order, it has mentioned that it was a purely a implication of failure of the internal governance, and internal governance which was not maintained properly. So there was not any way to identify the related party transaction. There are other two cases, the Fortis Healthcare and the United Spirit. In Fortis Healthcare, SEBI took steps against the promoter for diverting the fund via dubious internal corporate deposit within the group companies. So what's the company secretary's key role? So company secretary's key role should be to become a like compliance gatekeepers. They should ensure the companies adheres to the RPT provisions of the Companies Act and the LODR, continuous monitor the change in the law and update, maintain the statutory register and record properly, like tracking the board's approval, shareholders approval, for facilitating the boards and committee processes, papers, and circulate the meeting agenda for RPT reviews, ensure that interested director abstain from voting, coordinate with the timely filing with the regulatory authorities, collaborate with the finance team to ensure the accurate RPT disclosure in the annual reports and financial statements are made. The company secretary should advise the management on arm's length principle and best practices. They should act as a liaison between the board, audit committee, and statutory bodies with regard to the RPT compliances. And what should be the auditor's role? So they should identify the RPT risk and area during the audit planning phase, design the audit process to detect the unrecorded or improperly priced transaction, verification and testing. They should have some verification and testing methodology, like cross-checking with the MBP4 board meeting, financial statement, to identify the inconsistency, evaluate the arm's length price as per the which complies with the section 40 A subsection 2 of the Income Tax Act. Disclosure check, report and recommendation, highlight any material misstatement or control weakness to the management and audit committee, issue a qualified opinion or report if there is irregularity and which remains unresolved, because the external party mostly depends on the auditor's report. So auditor has to qualify the report whenever there is a violation of RTP transaction or some transaction are not disclosed properly or not at arm's length price. So the conclusion is AS 18 and India's 24, they significance of the related party, provide the emphasis on the significance of the related party disclosure to mitigate the conflict of the interest with the proper disclosure. It strengthen the investors' trust and increase the transparency. It's evaluation from AS 18 to Ind AS 24. So it says that Ind AS 18 also gives some disclosure requirement, but Ind AS 24 which align with the global IFRS standards. So Ind AS 24 goes beyond the AS 18 by encompassing the government linked transaction, extended family relationship definition, post employment schemes, global benchmarking, which aligning with the IFRS, boosting the international credibility. Materiality is introduced in Ind AS 24, which was not there in AS 18. Reduce the regulatory risk with clear disclosure. Investor gains the clarity on the potential conflict, leading to sound investment and lending decision from the disclosure made as per the standards. So, transparent related party transaction disclosure are central to the good corporate governance and safeguard the stakeholders' interest. The shift from AS 18 to 24 reflects the India's commitment to the global recognized standard, creating a stronger, more reliable financial reporting environment for companies and investor alike. So, thank you. Now we can go ahead with the question answers.
Okay. Thank you, Akshar. Very nice presentation. You have made everything very elaborately. Thanks a lot. Now let me start with the question where I left it. For Section 8 company, what needs to be actually followed? I think the question is about AS 18 or Ind AS 24. That's what he is asking here. For Section 8 company.
That's AS 18.
Okay. Register vendor under Section 189 of the company's contract arrangement which the director are interested. So does it mean it is not all the individual transactions are not required to be entered? Only one-time arrangement is to be entered? No, register 89, register in contract arrangement which the directors are interested. So does it mean not all the individual transactions are not required to be entered or one-time arrangement? It is not the question of one time. Any contract in which the director is interested, that is to be entered here. Okay. Can we get a copy of the presentation? I already answered it. If unlisted public company has crossed the related party transaction limit and 10% turnover before the SME listing, what shall be the complaints for the same? I think so.
That earlier question also
Discussed already.
Sudhakar answered actually. Because it's talked about a prior approval, you have to take all the things. That's what he said actually. Okay. Applicability, disclosure. Please explain what is the post-employment benefit means.
Post-employment benefit.
Retirement.
Post-retirement, yes. So all the gratuity, provident fund, superannuation that you will be entitled for are to be your post-retirement benefits.
What is the meaning of the undertaking? Suppose if a company write off loan of the related party will cover under the undertaking.
See, undertaking in what sense it is undertaking? In the is it 180 1 year reference or undertaking an obligation? Okay, writing off is not an obligation which you are taking it. Writing off is a decision of the company, decision of the management. Okay.
All the amount disclosed in the notes of the short-term borrowing and long-term borrowing in the financial statement, whether division 1 or division 2. I don't know what is this question actually. All the amount disclosed in the notes of short-term borrowing or long-term borrowing in the financial statement, whether division 1 or division 2,
That is, I think you're discussing about the transaction of borrowings. At that time, he's giving explanation, long term or bond term. Whether debentures
Okay.
or not, Atul's question, I think at that time the comment is made. All the borrowings.
Okay. Okay. In the disclosure AS 18 needed to be advance given 1 minute. Is the AS 18 disclosure needed to be advance given for executive director for complying the business travels and hotel expenses paid by the MD to the hotel or compelled by the company to MD regards.
Assuming that this is a normal transaction, so it's not required to be disclosed.
Recently, SEBI provides in the AC may rectify the RP transaction audit committee. If the same is not actually approved by the audit committee, but section 177 does not provide rectification of the RPT. And it says approval, that means in case of the listed company, we have to actually follow the CA or AC has to approve the same and cannot take the benefit of the rectification provided by the SEBI amendment until CA gets amended, line with the SEBI amendments. I think this is the recent amendment he is talking about, the third amendment of the
ratification of transactions not exceeding 1 crore is already there in the audit committee. 177, it is already there. It is already there in 188 also. Now it has been brought under Regulation 23. And only the difference is in Regulation 23, while SEBI is bringing this, they have very clearly written that transactions over a period of 1 year also. Okay, because some people they are interpreting 177 as per transaction, it is 1 crore. Whereas now SEBI has clearly brought it that it is not per transaction as far as Regulation 23 is concerned. Audit committee can give the ratification for 1 crore rupees, up to 1 crore rupees over a period. That means all the transactions with that particular related party, you have to combine it. That's what it is.
Mr. One question you missed. I will read it. To decide whether one is related party or not, which definition amongst accounting standard or Companies Act or under any act will prevail overall?
So that question has come earlier actually. That is why I skipped that question. That question.
No, DPG, Bala, if I can add something on this. See, basically, what we have to remember, you have a Companies Act, you have a SEBI regulations, you have AS 18, and you have Ind AS 24. So it's like this. A Companies Act is going to be applicable in all the cases, listed company or unlisted company. So you will have to comply with the requirement of Companies Act in any case. As regards the SEBI LODR is going to be applicable only when it is a listed company and not otherwise. Then again, if it is a listed company, then you have to follow what Ind AS 24 says. And if it is unlisted company, then you have to follow what AS 18 says. So it's not that all the companies have to comply with AS 18 as well as Ind AS 24. No, depending on as to whether you are listed or unlisted, you need to follow AS 18 or Ind AS 24.
Thank you.
Just to add to 1 minute, Bala, just to add to that, even in case of a listed company also, though they have to comply with both listing regulations as well as Companies Act. And you have to, several times this question has come up, which one is to be complied with? You have to comply with both, number one. Number two, higher the compliances. Say, for example, sometimes it may so happen you have been given exemption under Companies Act, but if the same exemption is not there in the listed companies, listing regulations, you cannot avail that exemption. Sometimes it may so happen you have been given exemption under the listing regulations. Same exemption may not be there in the Companies Act. I will give an example to you. For obtaining the shareholders' approval, if the threshold limit crosses, then you have to go to the shareholders. Whereas in case of listing regulations, it is material related party transaction. So when there are two things are there, unless if there is a disparity, then higher the compliance, whatever is there, that you have to comply.
To follow.
Yeah.
How to change the transaction on arm's length?
How to check?
How to check transaction is on arm's length?
I think this Akshar has covered in his presentation, talking about those four methods of deciding as to whether the transaction is at arm's length or it's not an arm's length. The simple definition of arm's length uh, is there anything more than what meets the eyes? So long as the consideration involved or the valuation involved is same which would have been with every other transaction. Apparently, this can be deemed to be a transaction which is at arm's length. But if the what meets the eyes, जो price है, जो valuation है, अगर वो normal transaction से कम है या normal transaction से ज़्यादा है, so that means there is something more than what the arm's length would be.
Moreover, Bala, arm's length is concerned as the Companies Act. They have not prescribed any methodology for that, and rightly so also. Because it may so happen, say, for example, when you are buying a house, there are two houses, one on the left side, one on the right side. The right side house may fetch more premium because it is having a two-way open, whereas the left side house may be having only one-way open. So it all depends upon that arm's length when the regulator comes and question you. Is it an arm's length transaction? You have to establish that.
Justify.
Most of the companies, what they do is they are actually following the transfer pricing norms under the Income Tax Act. That's what Akshar has mentioned also. See, this is because regulators are accepting this particular what's called as methodology. So prefer to that. Wherever it is possible, you go to the transfer pricing methodology. It is easy to establish that. But it is not mandatory for you. Maybe you can put some kind of a quotations, maybe market value, maybe all other supporting documents. At the end of the day, it is for you to establish that whether it is an arm's length or not.
What is the meaning of the materiality for the AOC2?
See, materiality for AOC2 under Companies Act, they have not defined materiality. So this, in fact, when we discussed about this related party transactions, we have also said that it is actually the fraternity we are taking it, the threshold limit for the shareholders' approval. Those transactions you can consider as material related party transactions.
Whether the CSR done through the group companies, a Section 8 company, will be treated as a RPT in terms of the Companies Act and LODR.
Yes.
A foreigner who's actually a director comes to India. His baggage is actually lost in the airlines. Company actually purchased the suit and other clothes, etc. for rupees 30,000 rupees. The director later gets his baggage. He takes the clothes purchased home. Is it related party transaction? Does it require disclosure?
It's
See, it is a director. This is not a strictly related party transaction. You are just courtesies extended. That's it.
No, Bala, it's like this. अगर वो director नहीं होता, कोई और employee होता, तो what company would have done? Check that actually.
Correct.
Okay. Is it disclosed under Section AS8 and related is
making... on the lighter side, I can say that the board meeting is over and there is a time actually before the director has to take his flight and the company has provided him a dinner. He did a related party transaction. These are the general courtesies extended.
Yes, sir. Is disclosed under AS8 related for making a debt or related party had to provision doubtful debt records? I think this we talked about it. This is rating of the debts, etc. As Dr. Chandrasre always say, we should actually invert the law. We have to go strictly by Section 188 or LODR provision of the RPT. Sorry, missed or not that we should not invent.
Just 1 minute, Bala. Let me also say one more thing also. Sometimes it may so happen. Say, for example, in Reliance, when I was working, we were having a joint venture company. In that joint venture company, the related party transactions, as per the joint venture agreement, any transaction between the shareholders, only two shareholders are there in the joint venture company. All the joint venture transaction between the related parties to be referred to the board. That means what? Under 188, though it is in the ordinary course of business, arm's length, but still that is to be brought it to the notice of the for the approval of the board. There in the minutes, we used to write very clearly that despite the fact that this is an ordinary course of business and arm's length transaction, as per the joint venture agreement, this transaction is being referred to the board for its approval. Because if you don't write that, what will happen is you have to ensure all the compliances of 188, which is not required in this case. What I'm trying to say here also, in this particular case, when you are writing off a debt pertaining to a related party, that point of time, you have to bring it to the notice of the audit committee as well as to the board that these are the bad debts which are proposed to be written off for the and put up to the approval of the board or audit committee, out of which so and so debt pertains to the related party, for which the necessary approvals were obtained at the time of the related party transaction entered into. And maybe in the minutes you may have to write, and similarly at the audit committee board, you have to discuss that under what circumstances that debt pertains to the related party has become bad. Sometimes it may so happen that particular related party might have gone to insolvency, might have gone into liquidation, might be some kind of a what's called a financial stress might have happened. That you have to bring it to the notice of the board, but not the approval under 177, under 188, and regulation 23. That is what my precise point. Okay.
In case of
I will leave it
expenses,
there.
in case of the expenses incurred by the holding company for its group, need to check out the cross charging of the same as per the agreement, which is actually entered into by the holding company, which is the group companies. The cross charging generally done keeping in mind the Companies Act, Income Tax Act, GST, transfer pricing, whatever is applicable. In case of the cross charge is not done, so it need not be disclosed the transaction, related party transaction. I think
Please
it is
refer to the guidance. Please refer to the guidance note about the group related party transactions, common expenses and all. Very clearly, the with examples, it has been elaborated in the guidance note. Similarly, sometimes a question comes whether the director has utilized the corporate debit card of the company and he has reimbursed it to the company. Is it a related party transaction or not? Like that, there are several questions out there which is very well aptly dealt with in the guidance note. Kindly refer to that.
Do we need to disclose the long-term borrowing from the director under AOC 2 in the annual filing? Also in AOC 4, is it to be disclosed?
What is that?
Do we need to disclose the long-term borrowing from director under AOC 2 in annual filing? Also in AOC 4, is it to be disclosed? AOC 4 is actually a financial statement. In financial statement, automatically the transaction would have been actually reflected.
And long-term borrowing, if RPT, is for the related party transactions.
Yeah, that is right. So definitely it has to find a place.
Yeah.
Whether the transaction between subsidiary to subsidiary are required to be disclosed.
Subsidiary is a related party, subsidiary to subsidiary.
Yeah.
If it is the listed company, yes, now regulation 23 covers that. Otherwise, not.
In case of the unlisted entity, should the transaction be approved by the board or just to be recorded?
Unlisted entity, should the transactions be approved by the board or just be recorded? Even for unlisted company and private company, also 188 and 177 are applicable.
Applicable.
Is the director,
you have to take approvals, not the recording.
is the director remuneration is RPT?
Yes.
गाइडेंस नोट में सब लिखा है.
Companies Act, listed entities, listed Indian entity has a subsidiary be in India itself, can see listed Saudi entity has a WOS in Saudi. These subsidiaries are creating a JV in Saudi. How does the RPT structure stand?
See, again, this question is, this type of questions are answered in the guidance note. If any transaction is happening between the subsidiaries overseas, okay, if it is an Indian company, not a listed company, because that subsidiary transactions, the cross transactions between the subsidiaries are not covered under the Companies Act, but covered under the regulation 23. So you have to see if your company is a listed company or unlisted company.
Friends, again and again, guidance note in RPT, we have worked a lot on that. Please refer. It's very beautiful book.
I said it in the very first place
Yeah.
itself. Please go through it. That
Yeah.
is why I said I expected this sort of a thing. That is why I actually made a mention about this guidance notes.
हमने बहुत मेहनत किया है, पढ़ना जरा.
Yes, that is right, Dipti. What made Morat Kia? You people have struggled to overwrite and you boil your
Yeah.
midnight oil. You brought out the very wonderful book.
Yeah.
I would say that. I said actually, in fact, I acknowledge this. My hats off to you people. If the transaction is pertaining to the promoter group, finance lease, how we can actually determine the arm's length transaction?
We have discussed this, Bala.
Should RBT be given each individual KMP voice with the names of the KMPs, or can it be grouped under the heading, say, rent paid to KMPs or remuneration paid to KMPs?
Prabhaji, your question, I think. This is about accounting standards, disclosures he's talking about.
Oh, can you repeat the question, Bala?
Should RPT be an individual KMP voice and the name of the KMP is to be grouped under the heading, say, rent paid to KMPs or remuneration paid to KMPs? That means he is asking whether you have to give an individual list or you have
Individual
to say
individual KMP wise. Yeah, individual KMP wise.
Correct.
which shareholder percentage of the shareholding can be treated as a related party. Significant shareholders, related party means how much percentage of shareholding.
Refer to, I think, the definitions part. There is no significant shareholder, nowhere it is there, if I'm not wrong.
Yeah, significant is there, materiality is there, and the LODR and the percentages has been provided in the definition. If the listed company pays advance tax on behalf of the MD, which is actually first paid by the company bank account by the MD, will it be transaction considered as RBT?
Not only
forget about RPT, it triggers
it's not
185.
permissible. Yeah, it's not permissible. I think.
It's not permissible. They should not pay at all
Wrong.
because it triggers 185.
Okay. Because industrial comparative values may not be available. I don't know this what it pertains to.
No, let it be. This Saudi
Okay.
case. Go next.
Okay. Indian entities take 41%, Saudi. Oh, okay. This is the same question, I think, what he said. Is AOC is actually applicable to all the transaction only or material transactions? I think this also we discussed. What is applicability AOC to in case of Aja? That we said actually. The transaction which is not the RPT as per the Companies Act, but it is the RPT as per the listing regulation. Listing regulation does not speak about the arm's length. Now it is actually required the RPT with a trust should be at the arm's length. If yes, why?
Basically, it says a transaction with a trust is not RPT as per Companies Act, but it is RPT as per LODR. LODR does not speak about arm's length. Now, is it required that RPT with trust should be at arm's length? If yes, why?
Actually, every RPT has to be at arm's length, whether mentioned or not mentioned.
Do we need to write long-term borrowing from the director AOC to? I think we talked about this. AOC to the arm's length basis only. That also we talked about it. Director resigned from the entity in the month of March and does not disclose about this to the companies, but in the MPP one given in April 1, and he deleted his name in that entity. Is it proper compliance by the director?
So he immediately didn't inform, but in MBP1 at the next year, he deleted that name of the company. How it can be compliance? He has to inform, right?
That's right.
Whether the RPT, which is in the ordinary course of the business and arm's length basis, is required to be mentioned in this 189 register. Whether the
not required.
Okay. A is actually a founding a partner of the private entity, and the fund invested to the extent around 1.5% of the listed company. can A be appointed the independent director on the board of such company?
Can you repeat the question, Bala?
A is a founding partner of a private entity, and the fund invested to the extent around 1.5% in a listed entity. Can
No, no,
A
no.
can A be appointed as the independent director in the board of such company?
See, you have to see, this is the question, nothing to do with RPT transactions. You have to see whether he is a qualified independent director under 149(6) or not. Accordingly, you have to take a call for that.
What is actually 1,000 crore turnovers threshold? Kindly repeat.
1 minute, Mr. Bala. It was the question was, A was a founding partner of private equity fund, and the fund invested to the extent of around 1.5% of a listed company. Can Mr. A be appointed as an independent? Acha, it is regarding independent director. Sorry, Sudhakar, you
When I say 149(6), you have to see.
Is the transaction pertaining to promoter group finance lease? How can we determine this? I think you said actually earlier. The same question is getting repeated. Is the ratification of the related party transaction without a prior approval of the board is sufficient for compliance?
See, I told earlier also, ratification is not a compliance at all. Under 177 as well as under 188, though there is a provision of ratification. What is if doesn't happen, if they are not ratify the transaction, what would happen? The company could have opted for that contract as voidable. As far as non-compliance is concerned, still it is there. Okay. So ratification, please don't think that the moment the audit committee ratifies the transaction or the board ratifies the transaction, it is not a non-compliance, because under both the sections, prior approval is required. So ratification is for a different purpose.
In case it is an SME unlisted company not having an audit committee for obtaining the approval of the shareholders, what should be the minimum percentage of the approval required from the shareholder?
It's not a listed entity.
SME unlisted company, that's what he's
Okay.
saying. I don't.
Okay.
He
Not
says it's not having an audit committee for
Right.
obtaining the approval from shareholders. What should be the minimum percentage of the approval required from the shareholders?
Is it related to RPT transaction or which transaction?
Or
it is?
normal transaction, yes. Is
What
he talking about related party transaction or a normal transaction?
No, we are not clear with the question.
If
We
it
are
is a
not clear
normal,
with that. We
if
are
it is
not
a
clear on that question.
yeah, if it is a normal transaction, then the normal approval will be required depending on what kind of transaction is this, whether it would require ordinary, whether the item which is to be transacted, depending on the nature of it, it may require ordinary resolution or a special resolution. If it is a normal transaction, it is SME, and if it is a related party transaction and there is no audit committee, assuming that this transaction is in the normal course of business and is at arm's length, then the board's approval will be enough.
Yeah.
What is the purpose of the audit committee approval if neither normal course or the business are arm's length?
Yeah, see, the audit committee purpose is to, in my understanding, it is not stated in any law, is to reduce the burden on the board of directors of scrutinizing each and every transaction. So audit committee, really speaking, is kind of a filter process, where, because audit committee is supposed to be comprising of the people who are supposed to be financially literate. So they are supposed to look at the transaction from the financial angle, from the legal angle, and therefore, every transaction does not have to go to the board, actually. This, in my view, is the purpose of the audit committee. Sudhakar sir can, of course, add
I
something
agree
more.
I agree with you. And over and above that, statutorily also, audit committee has certain terms of reference. Under
Yes.
that also, one of the things is they have to approve the what's called as related party transaction. So statutorily also, audit committees are under an obligation to approve the transactions.
In obtaining the shareholders' approval via shareholder meeting or proxies allowed?
Proxies are allowed.
is it required to obtain the board approval before taking the committee approval of audit committee? As the criteria is also specified in that resolution only. Please refer Rule 6A of the Companies Act meeting a board and powers rules 2014.
Yeah, see, that what he says is correct. Criteria for approving the omnibus basis, that is to be approved by the board. So first you have to take the board meeting, because the audit committee has to set up the criteria. Then it has to put up to the board. So you can adjourn the audit committee meeting, wait for the board meeting to take place, get the criteria approved by that, and based on the criteria, you reconvene the meeting, the adjourned meeting. You can give the approval on omnibus basis. That is what normally happens also.
I think next question is actually arm's length. I think we talked about the arm's length. Then does secured, unsecured loans to relatives or interested companies are actually attracted section 188 and has to be reported to the board report.
Financial transactions are not covered under 188. Okay. 188, only the transactions other than financial transactions are there. If you see that subsection 1A to F. So these transactions requires the approval of audit committee, and that board approval is not required. And of course, whatever the disclosures are to be given under the accounting standards, those are to be given.
Listed company acquired 100% shareholding of the unlisted company, become a wholly owned subsidiary company. The value of the RPT of the wholly owned subsidiary company is more than the materiality threshold, that is 10% to become the WOS of the listed company. Do this carry forward transaction would require shareholders' approval after the company is becoming a wholly owned subsidiary company, or prior approval to be taken only at the time of any increase or carry forward RPT of wholly owned subsidiary company.
You want me to repeat the question?
Listed company acquired 100% shareholder of unlisted company, becoming a wholly owned subsidiary company. The value of the RPTs of the wholly owned subsidiary company is more than the materiality threshold, that is 10%, before it become a wholly owned subsidiary company of listed company. Do this carry forward transaction would require shareholders' approval after the company has become a wholly owned subsidiary company, or prior approval to be taken only at the time of any increase in the carry forward RPTs or wholly owned subsidiary company.
See, if I understand the question correctly, the listed company has acquired the shareholding of another unlisted company which has entered certain related party transactions. That company, when it has entered into related party transactions, that board, that audit committee might have given the approvals and all. Post the listed company is acquiring those transactions, if any material related party transaction is there, which is going to be continued further, then under regulation 23, those transactions are to be approved by the shareholders of the listed entity. If they are not material related party transactions, then you don't need to. Even in case of material related party transactions, future amendments are there and all. Suppose, for example, today it is not material related party transaction, but in the course, during the course, if it becomes a material related party transaction, then also that point of time, the approval of the shareholders is required.
And we also need to check that this a threshold of 10% is applicable in case of listed company only, or it is also applicable in case of a wholly owned subsidiary of a listed company.
See, there are two types. One is that the transactions between the listed company and the wholly owned subsidiary are exempted. But if that wholly owned subsidiary is entering into any related party transactions, those transactions, if it is more than 10% of the standalone turnover of the wholly owned subsidiary, then they have to be referred to the audit committee approval of the listed entity. That's it.
Yeah, you have answered this question. His question was that only, that if that wholly owned subsidiary transaction is 10% above turnover before it become wholly owned subsidiary, and it is carry on transaction, which you clarified. Then whether it requires shareholders approval before becoming company, after company becoming wholly owned subsidiary, which you said if the transaction is continuing one, you need to take, right, Sudhakar? Yeah.
Then what about transfer of resources in other way? There is a RPT, and in fact, it's a fresh transaction. I don't get what it is exactly. Then what about transfer of resources in other way? Is it the RPT or in fact a fresh
Next,
transaction?
you can take it.
Okay.
That is all these comments when we were talking, no, writing of debts, they are telling that no, it is RPT and all that.
Okay. I agree that the related
No,
party
that
okay, that is all right. Direct benefit to the RPT, writing of the okay, these are all writing of the debt. Okay.
yeah. Now straight away you can come to question how a CS can guide on arm's length practices.
Hey, there's one more thing is there in between, I think so. Is it sufficient to obtain the board approval for a related transaction RPT for multiple financial years, such as 2 to 4 years? Or is it necessary to record transaction separating the register under the section 189 for each financial year, or just one for the entire duration?
See, it all depends upon how you are entering into the transaction. If it is a multi-year transaction, you will enter into, if you are entering into separate transactions year-wise, every year you are going to enter into a different thing. But if you are entering into a related party transaction, which needs to be executed over a period of time, next 5 years, 10 years, like that, once you got the approval, every year you don't need to get that approval of the transaction because you already entered into the agreement or contract, whatever it may be. Unless until there is a modification in or any changes in the terms of that particular contract, you don't need to obtain the approvals again and again.
The first proviso to section 188(1) provides that a company having paid up capital exceeding such a sum as may be prescribed cannot enter into the contract arrangement without the prior approval of such company by passing a resolution. In the relevant Rule 15, that is substituted by the company's meeting and board powers of the amendment, does not seem to be prescribed any amount to be paid up capital, although the Rule 15 prescribe about 10 crores are paid up capital in such scenario. What should be the amount to be the paid up capital? What is the relatives of the word having paid up share capital not less than such amount appearing in the aforesaid first proviso of section 188(1)?
It's 188 paid up capital amount is asking, such is according to me. The question is that what is the amount of paid up capital under 188(1)? Honestly, Mr. Bala, we are once at 1:45.
Yeah.
Please.
Yeah, I said in the beginning actually. Yeah.
We can.
One minute.
Yeah.
I will just answer the question. I'm just referring to that. Section 188, subsection 1, first proviso, provided that no contract or arrangement in the case of a company having a paid up share capital or not less than such amount of transactions exceeding such sums as may be prescribed shall be entered into except with the prior approval of the company by a resolution. Am I correct?
Yeah, right.
So this is nothing but Rule 15. You have to go to Rule 15. Rule 15, whatever the threshold limits are there, those threshold limits, if you are triggering, you have to go to the shareholders' approval. Earlier, it was a special resolution. Now it is an ordinary resolution. That's it.
Okay.
Okay, the definition of arm's length has been given. That is right, actually. In the example of two houses, what is the company is dealing in the painting? How can we actually define the arm's length in such a case?
Go ahead now.
Yeah.
Act to require disclosure of transaction 188. AOC to require disclosure of the transaction 188 only. loans of the related parties are not covered under Section 188. Somebody is saying
I
that.
agree with. I
He
agree with
said
that.
that. Sudhakar said,
Okay. Yeah. How can you actually please help me with the
yeah.
web link for guidance role of the related party transaction?
Go to ICSI website, and if I am not wrong, this is a priced publication. This is not free of cost.
Yeah.
So that is what I have been told.
Which shareholders will be related party?
Again, go to the definition.
Finish.
Yeah.
In case of the listed company entering into any material or RTP which requires the shareholders' approval, in this case, promoter is eligible in case of the vote on the EGM. In case of the listed company entering into any material RPT which requires the shareholder approval, in this case, can promoter be eligible to cast his own vote on the EGM?
See, as far as the promoters or shareholders voting in the general meeting is concerned, Companies Act has given some exemptions. If it is more than 90% of related parties, they can vote. If it is a private company, all those things are there. As far as Regulation 23 is concerned, the related parties cannot vote by approving the resolution. That means they can vote, but against the resolution, but not in favor of the resolution. Okay.
In case of the listed company entering into any
Same
material
question
RPT,
is repeated.
okay. In case of the listed entity entering the transaction, okay, is the same thing. Okay. To be a related party, how much shareholding percent that you are said? That's all. I think so. That's all the questions I think in this.
Last.
Like
Yeah.
143, 145. I think this is the longest webinar, I think. 2 hours, 45 minutes.
Yeah.
Akshay, credit goes to you.
Yeah. And after everyone is telling your table. I know many people must have taken photographs of your table.
Yeah, everybody is saying actually, can you share the table? That's what many people have said actually. That is one.
No,
And
it is
second thing is, there are a lot of appreciation messages also there in between. People have really appreciated your way of putting the things on your table, your presentation, etc. Well done, Akshay. Very great
Yeah.
job you have done. My hearty congratulations to you for bringing out such a nice presentations.
absolutely. As I already said, Akshay, it was truly a very comprehensive document. I think hats off to you and heartiest congratulations.
Thank you, sir.
Thanks, everyone. So it's time to close. We are having now delayed lunch today. Sorry for that, but it was a wonderful discussion. We have a lot of discussion and difference of opinion, and we like that kind of questions and discussions and all that. Pramodji, thanks a lot for bringing in such a vast and diversified knowledge and experience to us and sparing time on Saturday, and that also in this period. Thanks a lot for that. And
I too have thoroughly enjoyed with all of you the entire discussion. It's been immense learning for me as well, DPG. Thanks to all of you as well.
we are going to give more opportunity to enjoyment and learning because we want you again. So thanks everyone. Thanks Akshay for wonderful presentation. It shows your knowledge of CS, accounts, law and taxation. Wonderful presentation. Thanks participants for all your contributions by wonderful questions, interesting questions, and involving with the debates with panelists. We really appreciate that. Thank you, Sudhakarji. Thank you, Mr. Bala. Thanks everyone. Thank you. And wish you all Happy New Year in advance.
Thanks a lot.
Thank
Wish
you,
you a
and same
very,
to
very
you.
happy
Thank
New
you.
Year. Good weekend. So let us meet in the next New Year. All my best wishes for the prosperous New Year.
Happy New Year to all the participants, to every one of you. Happy New Year. Thank you.
Thank you. Bye-bye.
Bye-bye.